Good morning to our wonderful audience and welcome to the BCI Offshore Investment Manager webinar. At BCI, we are truly privileged to have partnered with some of the top global fund managers and that a lot of these managers you're going to see today, where we offer through BCI partnership a range of feeder funds. And big thanks for all of you that attended our live conferences over the past 2 weeks in Pretoria, Johannesburg, and Cape Town. It was really good to see all of you in person again, and a big thank you for joining us on this webinar again today. On screen now is the agenda for today. Olga, I don't know if you can maybe just put the agenda up quickly. We'll go through the agenda as we progress. Time allowing, we will cover some questions after each session from you, the audience, in our Q&A box as far as possible. If we don't get to all the questions, we will, as usual, circulate that to our presenters and provide you with some feedback afterwards. We are recording the session, and we will post a link to the recording as well as all the presentations of today in the BCI website under the Boutiques on Wednesdays tab. Just 12 months ago, we spoke of a Fed peaking maybe at 2%. And here we are 12 months later, almost at 5%. All markets seems to be lodestone to the Fed. Are there still some good, attractive investment opportunities for both growth and value stocks? Today, we'll hear a sensible argument in support of both. I believe the trend or trendy word in the world lately is pivot. First, we spoke of, when will inflation pivot? It started coming down. And now there's a lot of talk about when will central banks or the Fed pivot. Well, perhaps be careful what you wish for, because normally if the Fed or central banks only pivot when a system breaks. So let's see what will happen there. And should the Fed pivot, while the US economy remains strong on the back of resilient labor markets and consumer, while there's again talk of sticky wage inflation, it seems as if the Fed is trying to break the labor market to win the fight against inflation, and it is still problematic. So much talk about recession or hard or soft landing. So should we not pay more attention to the Fed creating tighter financial conditions and what impacts this may have on company earnings going forward? Over the past 2-3 weeks, a lot of talk again about China unlocking and how they can contribute to earnings or the rest of the globe. But also remember that markets are normally slow on the take-up of PMI numbers, a lot slower anyway than reacting to monetary news coming out of the US. Geopolitical plates are shifting, and as we've seen, the impact on global slowdown and price pressures continue, and that's always a factor that we can't account for, and it will always remain with us. It is my absolute privilege to welcome back, no stranger to any of us, is Chief Investment Officer of Credo, Dion Gous, looking at the world through a value lens. Dion, many thanks again for your time this morning and joining us. It's really great to have you all the way from London. And maybe just before you start, congratulations on the Raging Bull Award for Offshore Manager of the Year. It is truly a great achievement. I'm sure your emails and your phone is still going wild. I know your colleague Andrew also on the line at the moment. Big smiles this morning. From our side, really big congratulations and well done with that.
Thank you, Eugene. Much appreciated, and we're thankful for the award indeed. We hope that it leads to, even more flows into the fund on your platform. So we are indeed excited about the future. If I can just quickly try and share my screen, and I hope this works. In presentation mode.
Yes, absolutely perfect.
Okay, thank you very much. And thank you to the audience for tuning in early, not quite as early as we have it here in London. In fact, I have it on good authority that a number of the speakers today, I think, are speaking to you from London. And on behalf of all of us, I just want to thank you for the fact that, in spite of the forecasts from the International Monetary Fund, which were published a few weeks ago, which shows that if you look at the G7, all the countries will be showing some growth, except for Germany, that will be discussed over a year at some point in time. But in spite of that, the world is running away. Even Russia with its sanctions, and South Africa with its load shedding problems and its grey listing reality is forecast to be outperforming the UK. So much so that SA Tourism, as you know, kindly offered R1 billion to a small football club in North London a few weeks ago, just to get, through their cash flow problems. And all I can say is we appreciate, as I say, the fact that you give us your time and attention, in spite of the fact that we appear on this slide in such an economic quagmire. If we cast our mind back to where we were exactly 12 months ago, in fact, it was 53 weeks ago that we last spoke. That was the date. It was the end of February last year. It was the week of the invasion of Ukraine. And you can see what was really interesting people at the time. It was World War III, it was Ukraine. And sadly, 53 weeks later, the issue hasn't gone away. The main risks haven't gone away, but you can see that people have become quite wary about the issue. And it's attracting a lot less attention today. So from a geopolitical point of view, the risks are still there. I remember clearly, and some of you in the call will remember that on the day that I spoke, my friend Paul Crawford, we used to be colleagues, spoke after me, and he was very mindful of the Russian risk and what was potentially happening in Ukraine. And I agreed with him then, I agreed with him now that from a geopolitical point of view, clearly it's a big issue. But from a markets point of view, I would always argue that is something that you probably want to ignore. So my little dog, Elfie, who some of you may follow on Twitter, tweeted at the time that it wasn't really affecting his portfolio positioning. I do recommend that you follow Elfie. He gives more investment advice than me. His compliance is less strict than mine. But I think Elfie stands by his recommendation from that time that in spite of the geopolitical risks, I'm not sure that it should have too much of an impact on your portfolio positioning or your asset allocation. You've asked me to speak about a global outlook. And of course, as you probably know, those of you, who've been friends with Credo for some time, we don't really do forecasts. So I thought I'll share with you a selection of forecasts from the cleverest minds on Wall Street. These forecasts go back to the end of last year. These people are all extremely smart. You wouldn't find a bonus of less than $1 million on this page. And that is why they've got this perfect foresight, and they come up with this range of forecasts, some of them as much as 10% down from where the S&P actually started the year, so that's pretty bearish. And then some of them as much as 20% higher over the course of the year. 1 month into the new year, of course, we were already heading towards the top of that list, with 11 months to go. And, who knows where the year is going to end. We all know, if you've been following the market, that we're sitting roughly halfway on this, and we've got 10 months to go now. Ultimately, I think the truth is that nobody knows. In the Wall Street Journal at the end of January, focusing on a few of these sharp minds. On the bottom left, there's Cliff Asness, one of my personal heroes. I've been privileged enough to meet him a few times. He's the founder and chief investment officer of AQR, which is one of the funds and houses that we use in our multi-asset portfolios. But as Roger Lowenstein tweeted at the time, forecasters tell you more about the forecaster and not so much about the future. Lowenstein, of course, knows his stuff. I think some of you would have read his books. He's the one who wrote When Genius Failed, which is the book about LTCM in 1998. He also wrote what I think is the preeminent work on Warren Buffett, The Making of an American Capitalist. So when Lowenstein makes a point like that, I can only echo it. So I'm not really going to try and tell you too much about my own forecasts and tell you about myself in that way. As I say, we don't really believe in forecasting. We will simply focus on the way that we manage assets at Credo, which is ultimately without too much forecasting involved. Eugene, I think, very eloquently summarized a number of the issues that people are focusing on. And if you just look at the spike on the right-hand side of this slide, you can see that the implied Fed fund rate has captured in futures pricing and the like moved as much as 60 or 65 basis points just in a 10-day period a few weeks ago. And obviously this is based on remarks made by Jay Powell. But if you look at where it's come from over the last 6 or 8 months, you can see that it's effectively doubled. So the market has really sort of changed its mind rapidly and keeps on doing so. If you read Robert Armstrong, for example, who publishes a daily newsletter and a column in the FT, he wrote about this as recently as a couple of days ago, saying that the market keeps on splitting, another word that Eugene used there, between the bad news of essentially a strong economy with a strong labor market. But good news turns out to be bad news for the market. And on the other hand, the sort of inflation news and the implications of that for interest rates. And depending on which bit of news flow comes out in any particular week, that's what's been driving the market and will probably continue driving the market. For some time to come. And as Robert Armstrong happened. So I'm not going to suggest that I know better than the market or the sort of clever market participants from Wall Street. But I will, in spite of that, present a view in terms of how we should be investing.
Dion, apologies for interrupting. Dion, sorry about that. Your streaming seems to drop every now and again. It's not bad, but maybe if you kill your video, it will help.
Okay, I'm happy to do that.
Apologies for interrupting.
No, I get it. Let me just, no, I must, I'm trying to see where I can do it now. Because I'm in presentation mode, I can't find the button. Can I stop sharing and oh, there you go. Okay, I think you've killed my video. That's good.
Yeah, your video is gone. I can still see your presentation. If you can maybe just put it in full presentation there. Good. All good
Right,
to
thank
go.
you.
Apologies for that.
No problem. As I said, there's always a Warren Buffett quote. This one goes back to the height of the global financial crisis. We said that, and this is Warren Buffett, who knows a lot better than most of us, but they had no idea, what the movement of stocks will be. But if you do wait for the robins, spring will be over. And I think that is always true, regardless of what exactly is happening in the market at any point in time. So at Credo, we follow an investment philosophy which focuses on the intersection of value and quality, as we've always done. I'm not going to go into all the other points, but I think I just want to highlight that. And if you ask the question, why are we value investors? The short answer is because it works. And if you look at 200 years of history, and of course, there's different such a long period, we didn't really have daily share prices, for global markets as far back as 200 years. But there are information sources that have been put together in different studies. And that just explains the sort of annotation on that graph. Yes, you can see value has, with some volatility, has outperformed growth relatively consistently over the long term. If you look, however, at the short term, and by the short term, I mean the last decade or so, essentially since the global financial crisis, it's no secret that it's been an extremely tough time for value. So if we actually just focus on that drawdown, the relative drawdown of value compared to growth, you can see that value lost as much as 60%, 59%, which is the joint worst it's done in 200 years. If you go back to 1904, it happened to be the same number. But these two periods, 120 years ago and the most recent 10 years or so, have been the worst periods for value, which ultimately led to the biggest opportunity. If you look at the behavior of investors, if you go back less than 2 decades, something like 20 to 30% of funds in the world, depending on which geography you focus on, this is all value funds, but different geographies, between 20 and 30% were value funds. And of course, after a decade of value suffering, we can see that we ended the period with about 5 to 10% of value funds. So we were in a relatively small minority by the time that value reached its low point compared to growth. I love this slide. I mentioned Cliff Asness earlier. Cliff Asness published this in December of 2021, which in hindsight was very, very close to the exact top of the growth cycle relative to value. And he publishes blogs relatively often, but on this particular day, he only showed this graph, and he showed that over this period, over the last 30 years or so, how growth has run away from value, leading to this point of extreme overvaluation at that time. And of course, at the time, he didn't have perfect foresight that it was about to turn around and how sharply it might turn around. But he did update this graph 13 months later, and you can see that value has been a tailwind for the last year or so, which of course has helped our funds, ultimately helped with the award that was kindly given to us last night. But in spite of the fact that value has had a good period, in spite of the fact that value has had a good year, you can see that we don't believe that this is over. It's still in the 94th percentile. It may have been in the first percentile 13 months ago, but it's still in the 94th percentile as recently as 1 month ago. And that gives us hope and belief that the value cycle is likely to continue. If you go and unpack this and try and explain it, it links to inflation, which is stickier than people thought, as Eugene mentioned at the beginning. Ultimately, that means rates may be slightly higher for longer. Who knows how high rates will go and how long they'll stay there. But the one thing which I'm prepared to bet a fair amount of money on is that we're not going to see zero interest rates or the very near zero interest rates that we've seen for most of the last few years anytime soon again. For value is likely to remain. If you just go and look at the components of the MSCI World Index, we know that from the heady PE ratios of the high 20s, where we were a couple of years ago in the wake of the sort of COVID growth tech fang kind of bubble that was inflating more rapidly than before. It's down for the overall index now to about 17. But if you look at the growth component of that, that's still at 27. And importantly, if you look at the slightly longer term average of this growth, now, okay, maybe you can argue that 17 or 18 years is not such a long term, but it's a decent run. Growth has come down from the 40s down to the high 20s, but it's still higher than its own average over this period. And therefore, we think that there is still some air that could come out of it. On the contrary, if you look at the growth index, the value index today has a PE ratio of about 12 or 12.5, and that is still lower than its average over this same comparable period. So once again, I think there is room for value to keep on performing and for growth to keep on underperforming. No doubt some of my speakers that will follow today, I know they are growth strategists, they will have their own view on this, but from our perspective, this gives us a fair amount of conviction that our strategy has legs for some time to come. So just in summary, we think that the revenue multiple, which was such a popular metric and led to some of these overvaluations, the time for that is probably behind us. So just very briefly, where we find opportunity in global markets, and you can see that the global market is still dominated by the States. I've highlighted South Africa there for you at about 1% of the global opportunity set. Our friends at Vestec published this a month or so ago, just visualizing the equity market capitalization. And yes, the US has been extremely expensive, but it's still where most of the opportunities lie. Most global managers have been shunning the US, and you can see this from the Bank of America Global Fund Managers survey from a month ago, that the percentage of investors overweight US equities has been as low as we've seen in the last 20 years or so. If you look at the previous time that it was lower, it goes back to October 2005. For those of you who wonder what happened in October 2005, that was the aftermath of Hurricane Katrina. And of course, Hurricane Katrina didn't only happen in New Orleans. There was a lot of damage in other parts of the US as well. So there was belief that the US was facing a deep recession at that point in time. It quickly recovered, or relatively quickly. But it's the worst allocation, the lowest allocation since we heard those arguments 18 years ago. I love this blog post from Ben Carlson, involved with Ritholtz Wealth Management in New York. I published this about 6 months ago. And he gave his reasons why he remained bullish on the United States of America, in spite of relatively high share prices. And the ones that are relevant to us as investors are the bottom four. I'm not going to go into any of these arguments, except to say that I fully agree with all of them. And I still remain bullish about the US as well, and happy to invest there. And in the end, decent exposure to America. There are enough fish to be caught that are indeed cheap enough for us today. And therefore, if you look at the Global Equity Fund of Credo, 5 of the top 10 shares that we hold are indeed American stocks. If I add another one there, Flutter Entertainment, it may be listed in the UK, and it may be history going back to Ireland, but we really see it as an American stock because all the excitement about Flutter is essentially about sports betting in the US, which has been legalized across the country. Sports betting is legal today in 35 of the states, but it's not legal yet in either California or in Texas. California has an economy the size of the UK. Texas has an economy the size of Italy. And once those two are added, we think that the sort of runway for a company like Flutter will just continue delivering. The other stocks in our top 10 happen to be listed in the UK, but they're hardly British stocks. They are very much global stocks or with a focus on the Far East. So yes, we've got some UK exposure, but in terms of actual geographic exposure, it's much more US and international. Ultimately, when it comes to sector allocations, we are relatively overweight financials, relatively underweight. This has worked for us over the last year, and I think with the interest rate cycle being what it is, and the relevance of that for both these sectors, we are happy to remain that way. And then just very briefly, this is from TrustNet, the UK portfolio. This lists the Global Equity Fund relative to all its peers that are for sale in the UK market. And we're thankful to report today that we are top quartile over all periods from 5 minutes to 5 years, and in fact, since inception. And if you look at the margin by which we sort of beat those quartile rankings, you can see that it's pretty handsome as well. And that is what led to the 2 beautiful people on this picture picking up the Raging Bull on our behalf last night in Cape Town. Claudie Groenewald and Andrew Cormack, who I think are both on the call as well, and you can speak to them in the South African market. And as I say, very, very thankful for the award and very excited about the put or a toe in the water. Yes, we would suggest you do so. This is the usual uplifting message from our compliance department to echo what I've just said. And once again, just to thank you for your time, Eugene.
Dion, thank you so much for that. And apologies to the audience for the sound that broke up here and there. But Dion, we got the gist of it. We didn't lose you entirely. So I think every 30th word may be dropped off. But like I said, you know, we really get the gist of the presentation. Thank you very much for that. I don't see any questions from the audience. Maybe Dion, just from my side, you showed your geographical allocation predominantly still in the US. But what is your take on the dollar? Because it just doesn't seem to lose any steam. It keeps on going. And what is the impact on portfolio level?
Okay, those are 2 different questions, Eugene. Let me talk about portfolio level first. We don't really think about currency. We don't really think about top down. We don't really think about macro. We don't hedge. We are very much bottom up, and we will invest where we see value and we believe the value to have legs going forward. So at a portfolio level, you know, we're very happy to be quite exposed to the dollar, but as I say, it's a function of the bottom up. If you ask me about my view of the dollar relative to other currencies, I will always be a long-term dollar bull. I think, you know, you can ask me this question again next year or in 10 years' time, and I'll probably give you a version of this. Not because I'm analyzing the sort of short-term economic arguments and interest rate differentials or inflation differentials, because I know that's what the clever currency people do. I'm not one of them. But for me, ultimately, if you stand back from it at a big picture level, the strength of a currency is linked to the strength of the productive economy that backs it up. It's the collection of businesses that pay tax that can be spent, you know, by the fiscus. And that's ultimately what backs up a currency. And therefore, if you ask me, for example, the currency that is dear to me, the pound, because my life is in the UK, my personal balance sheet is dominated by my mortgage that I pay on a monthly basis, etc. So the pound is important to me. I earn in pounds. But what do I think of the pound relative to the dollar in 10, 20 years' time? Well, I frankly think that the dollar is likely to be stronger in 10, 20 years' time than it is today. For the simple reason that I've just said, the US is an economy which is about 8 times the size of the UK today. and it's growing. And the UK economy is contracting. So in 10 years' time, it's going to be 10 times, 12 times the size. And that ultimately has an impact on the currency as well. I mean, there's other currencies clearly that may be more interesting, smaller ones. I don't have much of a view on them. The euro could be interesting, but they must first get rid of their war. Certainly today, I'd rather be in the dollar than in any of the other mates.
Dion, thank you so much for that. There is a couple of questions coming in from the audience. We're unfortunately out of time and need to move on. I'm going to send that questions through to you and your team as well. For our audience out there, we've got Andrew based in SA as well as Louise. So if you have any questions for Credo or want to get in touch with them, please let us know and we'll get the right people through to you. Dion, again, thank you so much and good luck with your day, rest of your day in London. We'll chat in the near future again. Thank you so much.
Thank you.
Right, next up, we've got index funds and a great welcome to Anthony Ginsberg, Managing Director at Gins Global. Anthony, thank you so much for joining us, I believe all the way from Los Angeles in California. I don't know if you can hear me fine. I think it's a late evening for you, probably about 11, Tuesday evening, if that's right.
Yes. Hi from rainy California. It's great to be with you, Eugene. Eugene, thanks very much for the call, and I hope you can all hear me loud and clear.
Anthony, I can hear you fine. Do you want to share video, maybe?
I think your host has blocked the video. It's not from my side. There you go. Okay.
We'll fix it very quickly. There we go.
Right.
Sorry about that. I think they just switched all the videos off to try and get that line, a previous line, just a little bit better. But really looking forward to your presentation on index investing and how clients can access global markets at low costs. It's not only a cost argument. You've got other arguments as well why index investing is very sensible. And if you're ready, you can start with your presentation. Thank you again, Anthony, for your time this late evening. We're looking forward to it.
Thanks, Eugene. Actually, it's very interesting times for index funds because many people thought last year would be a very bad year for indexing, but indexing actually both in bull markets and bear markets has proven its due now over 3 to 4 decades. There's a reason why the majority of the largest pension funds in the world are still using indexing as a core for their portfolios. Hopefully you can see the slide, Eugene. I'll just...
Yes, we can see the slide. Anthony, I just want to check. Are you driving from your side, the slides?
Yes, but you can drive from your side. It's not a problem. Whatever is easier.
Yeah, can you maybe just put it in full presentation mode? I can see your slides, but it's still in the notes format.
Yeah, I'm happy for you to drive it. I think.
Okay, let's do that. Olga, if you could maybe just put the slides on from your side.
While we're doing that, I just wanted to thank many of your colleagues and also advisors on this call for their support over the last year. We did the product with BCI less than a year ago, and it's already raised around R1 billion. So it's one of the larger global equity index funds. We're tracking the MSCI World, which has got over 1,600 shares. And the MSCI World is actually a very steady broad index. Just to give you a brief background on it, it's a core global building block for most pension funds. Most institutional investors, certainly in the US where I am here in California, are using indexing as a core part of their global blend. So it's a collaborative blended approach. We're not here to say that active managers don't do the best job. There are many of my friends are active managers. There are a lot of smart active managers out there. The way it's generally used here in the US and even in Europe is it's a blend. We find it's a collaborative approach between indexing, passive and active. And the indexing typically is the low cost core. It helps average down the overall cost of the portfolio. I'll show you figures coming up that 80 to 90% of most active fund managers are not consistent enough to outperform an index like the S&P 500 or the MSCI World over most 5 to 10 year periods. And that's the reason why indexing, even last year, beat the majority of active fund managers, and actually had net positive inflows last year, according to Morningstar, when the active side of the business actually again had contracted. Over the last 10 years, we've seen a contraction in active fund management in terms of size and market share, and a growth in indexing. So the low cost I'm referring to is a TER in the 37 basis point area. It helps bring down the average cost. And really the issue with indexing is it's a diversified call, because it typically is 10 times as many shares than a normal global equity manager would have. If you think most global equity managers have between 30 to 40, maybe 60 shares, the MSCI I just referred to has over 1,600 shares. The US is the largest slice of that. So perhaps we can go on to the next slide. But the reason indexing is working is partly due to costs. A lot of the active fund managers overseas, the average fee out here is about 65 to 70 basis points. I know in South Africa it's more expensive. That hurdle rate, Eugene, is very difficult for them to overcome. And obviously this whole issue of value versus growth and underweighting, overweighting different regions is incredibly difficult, even for the smartest minds. The MSCI World, just to summarize, has all developed markets. So we're talking about the US being the largest constituent, but also Europe and the Asia Pacific region. And those are the key 20 countries essentially that make up the MSCI World. This is excluding emerging markets. So it's just developing markets. And we'll go on to the next couple of slides. I wanted to just show the relative consistency and also just the lack of volatility that you'll see in MSCI World in yellow against its sister, the minimum volatility MSCI, basically going back to 2007, 2008, all the way through to last year in US dollars. Even when the downturns came in 08 and during COVID, the recoveries were quite quick, and it's benefited from basically global diversification. But I would also say having 1,650 shares provides a balance. We don't have this narrowness of having our top 10 stocks representing 20, 30% of the portfolio. MSCI index and most index products, the largest holding typically is 2.5%, maybe 3% maximum. So you don't have this over concentration of the FANGs or of just a couple of large stocks. Thanks, Eugene. We'll go on to the next one. And I think the cost is really the reason why you see these numbers. So if we look at the global MSCI World in blue there, and we go to the first half of 2022, and we see that the percentage of active fund managers, according to Morningstar, only 31% of active fund managers beat the MSCI. That was in the first half of last year. The latest numbers just came out. Again, a majority did not beat the MSCI World, and nor did a majority beat the S&P 500. And then go over 5 years and over 10 years, the numbers get even more difficult for the average active manager. Essentially, 3/4 of active managers are underperforming. So it's trying to find a needle in a haystack. Certainly, certain years there are significantly clever active managers, but the challenge is to have that consistency. Very few of them over 3 to 5 year, and then going over to 10 years are consistently beating an MSCI type index. Again, this is a global equity index. It's typically used as the core building block for most, I would say, sovereign wealth funds, large pension funds, and many of the largest institutional investors globally, who will use both a combination of active and passive. So I keep saying to many of our clients, don't throw the baby out with the bathwater. It's a blend of both active and passive, and we remain friends with many very smart active managers. There's room for everybody. We'll go on to the next one. I just wanted to show the South African underperformance of South African fund managers. It's partly due to their higher costs and this higher hurdle rate that I referred to a bit earlier. If you look at the part that's circled in red there under global equity, these are South African fund managers underperforming a global index. It's essentially showing over 3 years, 5 years, and 10 years that close to 90% plus, certainly over 10 years and 5 years in the green and the red, have had a very, very tough time outperforming a global equity index. So I'm going to go to the very next slide and show you the numbers behind that. We're actually looking, in this case, at very similar to the MSCI World, it's called the S&P Global 1200. So MSCI World's a bit broader. It's got 1,650. This has got 1,200. Over both 5 and 10-year periods, in the yellow there, you'll see 96.5% of South African fund managers on the global equity side failed to beat the S&P Global 1200. For us, this is really a function of the difficulty of costs that they're incurring, essentially giving an index fund manager almost a 1% head start at the beginning of each year. And again, also the diversification that we benefit from. I'll move on to the next one. The reason I've put this in, Eugene, with the orange there with the S&P 500 is because the MSCI World includes the whole S&P 500. In fact, the US component at the moment is about 65% of the MSCI World. We're not that concerned about the PE ratio on the MSCI World at the moment. It's about 17 times earnings, so it's not excessive by historical methods. But this is just comparing the JSE All Share to the S&P 500 in Rand terms. And I guess the point is the market has come down, certainly last year. We see it as a buying opportunity. Our investors are obviously long-term. We're not trying to time markets, and we don't bet against the US. The US has steadily grown in the MSCI World from about a 50% weighting, I'm going back 20 years, to today being just over 65%. And that's based on market cap. And we obviously the S&P 500 on its own is very difficult to outperform. In fact, I'll show you some numbers that US fund managers themselves, the vast majority, fail miserably every year to beat the S&P 500. And we'll get to that in a moment. This is just summarizing actually how US fund managers who have on average much lower active fees, around 65 basis points for their global funds. You'll see in yellow there that the 10-year column, essentially 90.5% of US fund managers are failing to beat a global equity benchmark like the S&P Global 1200 or the MSCI World, which is very, very similar. And it's not a one-off. We see this across the board with the S&P 500 numbers as well. So I'm just going to take you across the globe now to Europe and show you some numbers there as well on the next slide. It's a similar story. The European fund managers in euros is the top line. It shows over 5 and 10 years between 94.9 and 98% roughly underperformed the same index. And those operating in pounds were also 90% of the time over these longer periods underperforming. Even if you go to the shorter period, year to date, that was back in 2022, we think that there's a myth of the stock picker that many people say, yeah, when there's a bear market, Anthony, how can the index guys still do well? The truth is that we've found that most of the studies, the academic studies by many Nobel laureates, show that the cash component of active managers, which should go sky high in a bear market, doesn't reflect that. They don't all move to cash so that they can actually outperform the index. And typically, over both bull and bear markets, this cost advantage gives index funds really an unfair head start. I'll just go to one or two more slides, Eugene, and happy to take some questions. This is the home turf of the American market, the S&P 500. And even there, the smartest guys from the Harvards and Oxfords and other places, over 10 years, 90% are failing to beat the index. That's the 10-year for the S&P 500. We've also shown you the mid cap and the small cap there. You could say, Anthony, why are the numbers so atrocious? 25, 30 years ago, Eugene, there were less CFAs out there. There were less analysts. Some people would argue that information was shared a little bit more freely on the golf course back in the day. So maybe guys had a bit of an upper hand if they were good golfers, if you get my drift. And I guess my point here is that it's become incredibly difficult over the last 15 to 20 years with all the new regulations where companies reporting has to be public. They can't, release information privately to individual fund managers. So they can't play favorites. It's become incredibly difficult over the last 15 to 20 years to consistently outperform. So these numbers have been progressively getting worse for active fund managers. Certainly in the US, where indexing is now an established fact, almost 50% of mutual fund flows on an annual basis are going into indexing in the States. In fact, as of last year, up to 60% of fund flows came into the index space. So again, we're saying one should have a balanced approach using some indexing and some active. I'm not here to say one is better than the other, but we've seen that it's very hard to consistently pick the star fund managers. So we see that last year, the stock pickers myth was shown up again because the majority of the guys last year, again, underperformed on the active side. Just to summarize then, bull markets or bear markets, it doesn't actually favor an active manager necessarily. Indexing by its nature is broad and it's more diversified. It's typically sometimes 10 to 20 times more diversification in the index. So for 37 basis points at a low cost, you're essentially getting the entire global developed stock market in the MSCI world for a very, very low fee. Some people would say, Anthony, it's sort of a brain dead offering. Just put a part of your core portfolio in there. It'll bring down the average IFA's average cost for his portfolio. And we see, I'm sure there are DFMs and others who are also increasingly following the lead of the UK and the US, where they will use indexing as a blended tool with other active fund managers. And with that, I just want to thank everybody for your support over the last 9-10 months. It's been very reassuring despite the tough markets we're in. And I'm very happy to take some questions as well.
Anthony, we're very much out of time. Very quick question. And just back to that cost factor, 37 basis points, that is a true TIC that includes VAT and everything, including trading costs. And maybe just on that point, relative to peers or similar index funds, you've got a very low tracking error, certainly to better than most. But how do you achieve that while keeping costs extremely low?
Yes, the answer is we've actually, for the past 20 years, worked with State Street, which is one of the top 3 index fund managers globally. They're not as well known on the retail side, perhaps, but they actually manage a lot of sovereign wealth and institutional pension fund money. And what they've given us is really very, very low cost fees that allows the tracking error to be minimal. We found also by focusing more on an institutional sub-advisor like State Street, we don't have huge flows that could disturb the tracking error. You know, there are certain ETFs out there, for example, that may have massive flows day to day. We actually, in this particular MSCI World Index portfolio that's actually domiciled in Mauritius, which is favorable as well tax-wise, we are not having massive in and out flows on a daily basis. It's a pretty long-term buy and hold strategy, and it helps, Eugene, to keep the tracking error very, very tight. So we're talking about a 3 to 4, 5 basis point tracking error. Typically, one of the reasons is that we have, there are tax strategies that State Street are able to offer us. They're operating in about 30 countries, and cross-border dividend flows benefit us. So we can actually, bizarrely, the MSCI World assumes very high cross-border taxes on dividends, and we're actually able to reduce those through tax treaties that State Street take advantage of. So just put my old tax accountant hat on for a minute. That's quite important when you've got 2-3% dividend yields coming out of the US, and you can actually reduce your withholding tax by a substantial amount.
Very interesting indeed. And Anthony, from our side, from the BCI team, our audience, thank you so much for your time. And do I say good night and sleep tight?
Good night.
We'll chat to you soon in the near future, and looking forward to hear a little bit more about you. We're a little bit, thank you so much. We're a little bit behind schedule. I'll steal some time somewhere else. Next up, and joining us now all the way from Jersey, is Chief Investment Officer from Martello Asset Management, Phil Rose. Phil, good morning, and thank you so much for joining us. Maybe just for the audience sake, Phil has over 30 years, extensive experience in asset allocation and equity selection. Before he joined Martello, he was investment director at Brooks McDonald. Martello is active asset manager, bottom-up approach, and they do their own company research and don't really lend out their ears to other external analysts. Phil, again, thank you so much for your time this morning. And we look forward in you sharing your investment philosophy and how this comes together in the BCI Martello Global Equity Feeder Fund.
Great, thanks very much. Hopefully you can hear me okay. Thanks very much for inviting me along today. It's great. Yeah, as Eugene was saying, I do the research for Martello, and I've probably been doing research for about 30 years now. And every time I go into one of these sort of pooled conferences, it's amazing how many different views there are and different ways of doing the same thing. And yet we all get the opportunity to make money for our clients. So there isn't a right way. I would probably say there's quite a few wrong ways of doing things, but there's not a right way to do it. And we all get the opportunity to make money for clients. There's something magical, I think, about the thrill of the chase, finding the winner, finding a stock that is going to go up. That's kind of what drives you forward every day. And I reckon sitting at my desk that every day you go home and think, yes, what a good day, mostly anyway. So where are we? Let's go on a slide, please, if we can. If we look at volatility, money is just ricocheting around the market. Investors are trying to find answers. Where are we going? What's happening? There's so many variables at the moment that money is just flying all over the place. However, we don't think there's evidence yet that there's an imminent collapse. We've heard so much talk about recession and all that sort of stuff, but we don't see that yet in front of us. Many investors, however, I think we've already heard this morning, many investors have been wrong-footed during 2022. It was a nightmare year if you didn't get it right. And some people were significantly down. And even the month-by-month movements were extraordinary in the marketplace. So what do we look for? We try and look for companies with very, very specific characteristics. We've got a very high active share. We're benchmark aware, but we're certainly not benchmark followers. We just look for great companies. If you can find those companies in the marketplace, then you can successfully make monies for your clients. I think the US economy we've seen has been so resilient. Jobs, inflation, corporate earnings. We've just been through the corporate earnings season. And mostly people said it was okay. There's a few disappointments, but mostly people said things were okay. So that also doesn't imply that things are about to collapse. 2023 seems to be a year of change. Money's moving, and you've got to find it. A kind of phrase that goes through my mind is, where is that smart money going? If you can find where that smart money is going, then you have the opportunity to benefit for your clients. Let's move on. Just a couple of little charts here. Our macro, we're mainly bottom up. So I'm macro aware, but I wouldn't say I'm an economist sitting there staring at macro figures all the time. However, these are a couple of interesting charts. You've got the typical sine wave, expansion, trough, recession, and then you go through it. Where are we at the moment? We think in the US, we are here. That's that little nodule there. We also believe maybe in Europe and UK is further back from that. So there's still a bit further to go. So we haven't got to the crest of the hill. When we get to the crest of the hill, it will begin to show itself. We'll be able to see the other side, and that will give us a tip off as to what's coming. But at the moment, we don't think we're at the crest of the hill yet. China lockdown easing. They had some figures out this morning, I think, which showed that they're growing faster than we would have anticipated. So what they've done with unlocking down is they've now released a huge swathe of spending and consumers around the world again, which might stave us off from a significant sort of downturn. This new money is just about to hit the market. It's been locked away for a year. So on the right, what we've got is two sort of lines. One is the long-term policy projection for the interest rates in the US, and the other one is the longer term GDP projection. We've also already heard from Dean, I think he was saying that the interest rate projection has been moving up quite quickly recently. So that gap is beginning to close, but it needs to close further. Either interest rates need to keep moving up or GDP needs to keep moving down. But currently, neither of those things is happening fast enough. So I think the world's missing something here in what's going on. Let's move on again. So what are we looking for in Martello when we sort of sit and stare at the markets, which is basically my job really, to sit and stare at the markets and work out what's going on. What are we looking for? We have to find companies that can live in a higher inflation world. Inflation looks like it's going to be higher for longer. So companies have to be able to survive that. Maybe that's the banks, maybe it's the commodity companies, maybe it's some of the consumer staples that are able to pass on higher prices. Maybe those companies will be successful. Companies that don't have high debt. Now, lots of companies have borrowed a lot in the last 10 years. If interest rates double or treble, that's really going to hit them hard. They're going to have to find some way of reducing that debt. So we try and look for companies that don't have that debt burden behind them. Companies that benefit post-COVID. We've seen a lot of rallies in travel, healthcare, retail, leisure, all those sorts of companies that have been locked away for a couple of years. They're now beginning to see the light of day again. So perhaps there are some ideas there that are going to excite investors and help us to make some money. Finding the right companies is just never easy. We have a universe of about 1,200 companies. The way we look at things, we can scan that entire universe in the morning, maybe. We can find out where the money's going, where this smart money is ending up. And that will give us a tip as to what sectors are beginning to move, what stocks are beginning to move, which companies are able to deal with the environment, and really provides insight to us as to, the way ahead. Let's move on again. This is something we kind of look at quite a lot, really. We can do it with markets, with sectors, with individual stocks. You look at the relative performance of those things versus something, the MSCI World, for example. In this particular case, I've got the US market, I've got the UK market, I've got the European market, and I've got the emerging markets market. So we can see from the US market, top left, it's just beginning to turn down a bit. And that is after an enormous spell. This is 10 years. It's probably been more than that, but a 10-year spell of outperformance in the US versus the world market. But we've seen where the money is now flowing. If you look at the UK one, bottom left, and Europe market, top right, you can see those ones relative to the market have stabilized and begun to push forward. So money is moving. Money is definitely moving. These are 10-year charts, but this is generational change. This underperformance of UK and Europe has probably gone on for 15 years now versus the US. So people are now waking up to Europe and the UK, and there are real opportunities in those markets. So don't underestimate the power of money moving that allows you to make smart decisions. Smart decisions means making money. Let's move on again. Okay, sort of kind of going back to the same sort of story, really. Who is winning in the new environment? There's just a selection of names here. Luxury goods, China, that is. That's about China. We've got LVMH, we've got Hermes. You've got L'Oreal, which actually probably has a high exposure to China as well. You've got hotels, you've got Hyatt hotels we've got in our portfolios. They've actually significantly benefited sort of in the post-COVID world. We track commodity prices. You've seen copper, iron ore, steel increasing during 2023. Why is that? If we're going into a recession, why are people buying copper, iron ore, and steel? Again, is it about China restocking their reserves? Banks and financials. We've got quite a few financials in our portfolios. We've tended to drift away from the US into Europe. So we've got HSBC it is UK, but it's not really a UK exposure. You've got Nordea, which is Scandinavian. You've got UBS in Switzerland. You've got American Express, which is peculiarly one of the credit cards that actually physically lends money as well. So they benefit from higher interest rates, and they came out with some great earnings. You've got Zurich, which is your general insurance, your cars, your life, your healthcare. Those sorts of companies are benefiting in the current environment. Some of them we leave on the table. We didn't really touch the luxury goods because perhaps they're a little bit expensive for us, and we just decided to leave them on the table. But no one gets it right all the time. What you've got to do is find where the money's going, find the stocks that are benefiting, and tip the odds in your favor. If you can tip the odds in your favor, then you can make money for clients, and that's all we're here for. If you can get 70% right, you're doing really, really well in today's environment. And 70% right means you should, despite the previous talker, and sympathy to him, despite the previous talker, you should be able to outperform the markets if you get 70% of your stock selection right. Okay, let's move on. This is just some details about our global equity fund. We have, as Eugene was saying, a BCI feeder fund that feeds into our F class, but since you're going to get the pack, you will have the details in front of you of how to find those relative instruments. So let's move on from there and just keep talking about markets and what's going on. What we do at Martello, we try and do things differently. Our methodology is really, really structured and rigorous. We go through the same routine. It's a bit kind of a fixed parameter for me. You go through the same routine over and over and over again, and you find the same thing over and over again. And if it's the right thing, just keep doing it. Don't change, just keep doing the right thing. We look back 20 years. We're not necessarily looking for the new up and coming companies. We're looking for the ones that have a history of getting it right over and over again. As again, Eugene was saying, we're independent. We read other people's research. That's perfectly fine. But we'd like to start from a blank page, create our own ideas, then go and see what other people think about stocks as well. And I mentioned before, we've got a universe of about 1,200 stocks, and we can scan them all in a morning to try and find a list of ideas that we go on from there. Since we're about 11 and a half minutes in, I'm going to skip a couple of slides. So if we can go forward 2, do you think? Not that one. Not that one. Let's go to that one. Let's talk about some specific ideas. I wanted to talk about technology. We've been underweight technology for a while now, and it's significantly benefited us by being underweight technology. However, we've got a few names in the portfolio now that we've nudged up our technology exposure, and they're very, very specific, and they're not necessarily the mega cap stocks. We've got Amadeus, which is software for your technology. When you book your holiday, they probably provide the software for it. ASML, they build the machines that build chips. That's also been doing very well recently. CGI is a Canadian company, I believe. They're IT outsourcing. That's been doing very well recently. Texas Instruments is analog chips. So it's sound, vision, temperature, everything we see and feel. Their chips turn into a digital signal. It's useful in a whole huge range of products. They've been doing quite well. And Visa, I saw Visa coming up in somebody else's portfolio. That's about transactions. The more we spend, the more transactions we do. Visa do very well indeed. Thank you very much. So if we look at the performance of those over 6 months, Amadeus 34%, ASML 47%, Visa 25%. If we look at some of the mega caps, Apple 7%, Microsoft 7%, Google down 6%, Amazon down 17%. You don't have to have the mega caps. By using good stock selection and finding where the money is, you can find good stocks. Let's move on. If we look at financials, I said that we'd sort of gravitated away from the US into Europe. So if HSBC is about Asia, probably. UBS is about a little bit of US exposure and a little bit of Europe exposure. Nordea is about Scandinavian exposure. So you can cover world banking with just a handful of stocks, and they happen to be European. Zurich is about basic insurance. And then American Express, I said, is exposed to actual lending, so they can make money from the amount of money we borrow. Unfortunately, we're still borrowing more and more money, and Amex are benefiting from that. Their last report was very, very good. Let's move one further. Energy. We were in energy quite early. We saw that trend happening through the relative sort of picture of where the money was flowing. BP, Exxon are both in our portfolios. We've banked profits probably about 2 or 3 times on them. Schlumberger, the middleman. If you want a well-built, or you want it to be more efficient, or you want some equipment, or you want something, you go to Schlumberger to get that. So we've been in the energy industry for quite a while now, and we've made substantial benefits from being in there. Again, one further slide forward. Again, this is our sort of sectoral and distribution. You can see that we've neutralized our technology underweight. We're now almost market weight technology, but not in your mega caps. Sector-wise, we're overweight financials. What else are we doing? We're a little bit neutral on industrials. Industrials is a huge, broad sector. But the key thing I wanted to kind of stress here is the bottom left-hand chart here. USA 49.9. We've gone below 50% in the US for, I don't know, probably 10, 15 years. We've never been less than 50% in the US, because we are now finding ideas in Europe that really excite us. There's great companies in the US, I wouldn't deny that at all, but stock specific wise, we're seeing really good names in Europe, and that's where we're finding names. that actually brings it to a close. So happy to open it to the floor, or if Eugene's got any comments, or let's move on from there.
Paul, thank you so much for that. Your presentation is always very interesting. And if I look at your holdings, you know, a lot different to what we see from some of the other mega funds. Maybe just on that point, energy companies like Exxon that you hold as well.
Yeah.
Your views in short on energy prices, oil prices going forward, and does that forward outlook influence the kind of energy companies that you may or may not hold?
Yeah, that's a sector that we have been looking at very, very closely and watching very closely. I think what's important to us here is what's going to happen in China when they open up and manufacturing really fires up. And are the US going to go mad to try and rebuild their reserves? If those two things happen in sync, we might see the oil price stay high or perhaps even drive higher. If we see weakness, we will be onto it, because one of our definite criteria, never fall in love with anything. So, you know, we will watch these things very closely. Currently, we feel that there's probably upward pressure rather than downward pressure, with China and the US stock reserves being too low.
A lot of sense. Very last question. You spoke about the tech companies as well. You've shown some tech companies that you hold, but why then not the big mega tech companies like the typical Alphabets and Apples that you've seen quite often in other holdings? Yeah,
I'd love to hold those stocks. You know, I like the companies. They're great companies. If we look at the last earnings reports, when I said most companies actually reported good earnings, Apple kind of wasn't that exciting. And they didn't sell quite as much product as they anticipated, as the market anticipated. Google said advertising spend was slipping a bit. There's just kind of cracks in some of the earnings reports that came through on those. And if earnings, which I believe earnings longer term build wealth for companies and therefore for their investors, if you see cracks, place the money somewhere else for the time being. If Apple and Alphabet get it back together again, great, I'll go back there, but not at this precise moment.
You think that those cracks in earnings numbers may continue as liquidity starts to drain from the US market?
That is possible, yeah. I mean, I just a phrase I learned from a technical trader. He said, trade what you see, not what you think, because what you think is ultimately a guess. And so, you know, we watch these things to see how they develop. It is quite possible that if money drains from the US, then some of these mega caps will be replaced by mega caps from UK and Europe. But yeah, these are such big companies, they're never going to lose a huge amount of investors. You just have to watch the price. If the demand's not there, the price will be stagnant, and it's not therefore the place to be.
Very quick question from our audience, last one. What is your view on the commodity basket, especially supporting the green revolution?
Oh, gosh. I think the commodity basket really is probably another China story. If they need to restock their inventories and crank up manufacturing, they're going to want iron ore, they're going to want steel, although they make a lot of it there. They're going to want oil, they're going to want copper. If that's the case, then these prices are going to continue upwards. They have done this year. There's no evidence that they're falling over, but it's that China's the key to that one. I can't see there's any other choice, but China is key to that market.
To continue our conversation, we're unfortunately out of time. I need to move along with the other speakers as well. Thank you so much again for joining us, and we really look forward to engaging with you in the very near future again. Thank you.
It's a pleasure. Great pleasure. Thanks.
Our very last session before tea break, not for the day though, is with Lindsay Train, and it is my privilege to welcome Madeleine Wright, based in London. She is Deputy Portfolio Manager at Lindsay Train and works closely with co-founder Nick Train. Their portfolios are highly concentrated in what they judge to be exceptional businesses. Madeleine, thank you so much for joining us in your time this morning. We look a lot forward to your presentation and how you still manage to find these exceptional businesses given the market conditions that we are in.
No, good morning, everyone, and thank you very, very much for having me. Let's start with the investment principles slide. Thank you. So I thought I'd begin with a quick gallop through who we are and what we do. These are our investment principles, not many of them. I'm sure you'll agree there are definitely worse places to start than with a bit of Warren Buffett. We have been influenced by many investors, but arguably Warren Buffett the most. And that quote on the right there nicely encapsulates our approach to investing. Buy shares in a great business for less than it's worth and own it forever. So we look, as you've said, for exceptional companies with some kind of defensive moat or unique quality, which has enabled the business to endure in the past. The average age of our portfolio companies is 120 years. And for that moat to likely to allow it to continue delivering returns well into the future. These kind of businesses are really very rare. They become even rarer when you're taking a time horizon of, well, hopefully forever, as Warren Buffett says, but in practice for us, at least 20 years out. We think that most investors tend to undervalue these kinds of really durable business franchises. And that's in no small part because their time horizons tend to be too short to appreciate the compounding effects of truly durable cash flows. Hence the need for time and patience. The scarcity of these sorts of businesses means that our portfolios are necessarily concentrated. But as we view risk as the permanent loss of invested capital, we'd rather have fewer great companies than lots of mediocre ones. Ultimately, we believe that running concentrated portfolios with companies we're really optimistic about in the long term is the best way to reduce risk and deliver returns. Next slide, please. So here's our global equity portfolio itself, definitely concentrated with just 24 companies in total, broadly split into three key buckets: consumer and healthcare franchises, media and software, and financials and networks. We think all of these companies own deeply resonant and durable brands, unique intellectual property, and irreplaceable products and services. And for the rest of my time today, I want to dive a bit deeper into a theme that's relevant across the portfolio: how all of these wonderful products and services offer our companies, and therefore our investors, critical protection against inflation, both historically and out into the future. Next slide, please. Inflation, it's unquestionably been in the news of late. Judging by the number of questions we get on it, it's one of our clients' top concerns. Let's be really clear. We're not making predictions. We're not saying that we think there will be lots of inflation to come. We just don't know. But what we do know is that a significant part of the value of companies is their potential to protect against inflation if it happens. It makes sense to us that investors are willing to put a high price on inflation protection, perhaps through the use of index-linked gilts. But to our mind, some companies, the kinds of companies that we own, can offer this, plus the possibility of real growth on top. So as a reminder, this next slide is what inflation has done to purchasing power in three key markets over the last 50 years. Between 1972 and 2022, the US has seen a 7-fold rise in prices, and the UK a 14-fold rise. And despite unusual periods of deflation, over that 50-year period, even Japan has seen prices triple. As something of a transatlantic example, at the bottom of the slide, you've got a ticket from the Rolling Stones 1972 US tour, which you can see was priced at a bargain $6.50, and that is including free parking. In 2021, you'd have been looking at $556 to see the same band. That is serious inflation protection for you, and a great illustration of why we at Lindsell Train think uniquely durable, evergreen entertainment content of all kinds is hugely valuable. Rather like, if I may say, the uniquely durable and valuable Mick Jagger. Anyway, next slide, please. Inflation is perhaps most evident day to day in our shopping basket. And as many of you may know, Lindsell Train's basket includes Heineken. It's been an important holding in our portfolios for over 10 years. We think it's a great example of how a really resilient brand and the pricing power associated with that can underpin business growth over the long term. Today, I want to focus on Heineken's ability to price in the US. The Heineken brand has a long and storied history here. It was the very first imported beer to enter after Prohibition in 1933. So Heineken had already been established as an exclusive premium beer brand for a whole 22 years by the time the Brass Rail restaurant in New York City printed this drinks menu in 1955. Next slide, please. Down at the bottom, I hope you can see that a bottle of Heineken is priced at 50 cents. Today, the same bottle is on average 18 times more expensive. Compare that to US inflation, which stands at 11 times in the same period. Pleasingly, there are a couple of other Lindsell Train investments on the menu, Johnny Walker and Remy Martin, both of which have increased their price 21 times, thoroughly outpacing US inflation. But back to Heineken. Protected by its premium brand, the business has expanded its global volumes both organically and via acquisition. Sadly, Bloomberg data doesn't go back to 1955, but from its earliest date of 1989 to 2021, Heineken's revenues have increased ninefold, and its operating margins have expanded by well over 50%. And all of this has added up to satisfying, refreshing returns for shareholders over time. Next graph, please. If you had held Heineken since 1989, you would have been the happy recipient of a 4,400% total return, which comprehensively beats the MSCI World Index over the same period. But will all this continue into the future? The most recent numbers seem to suggest so, especially premium beer volume growth of 15% and overall pricing of 13%. Next slide, please. I couldn't resist showing you this slide from Lindsell Train's very first annual update that we gave in 2008. Cadbury's the key point here. And it's relevant because it's owned by Mondelez, one of our biggest holdings. Cadbury is the world's #2 chocolate brand with a track record of serious inflation busting, as we pointed out back then. And updating this for end 2022 in the purple circle there shows that this pattern continues to hold true. But the real reason I wanted to blow the dust off this slide is because it shows that seeking the protective and value building qualities of pricing power has always been a central part of the way Lindsell Train has approached the investment challenge. We think about it across all categories of consumer goods, including luxury and premium. Next slide, please. Here's luxury Japanese cosmetics manufacturer Shiseido's oldest product, Udamine. It's a face lotion which launched in 1897 and is still going strong. Back in 1897, it was priced at 25 sen. According to Shiseido, this was still 2.5 times higher priced than other skin lotions at the time. It's now priced at 8,800 yen, which means that Udamine has delivered an annualized price increase of just under 9% over the intervening 125 years. All of these examples to us, from beer to cosmetics, show the power of owning a truly differentiated brand with history, heritage, staying power, and consumer resonance over the longer term. But inflation protection isn't just relevant to consumer goods. It's also crucial for another key idea for Lindsell Train, IP and software. Next slide, please. I'd like to use Intuit, which is an important holding in our global strategy, to demonstrate how truly differentiated software companies can benefit not only from the headline pricing power of owning an essential product, but also from the shift to subscription transforming their business models. We think this is another form of price protection, and it's something relevant not only for Intuit, but many of our other holdings, including Adobe, Relics, and even Nintendo. Intuit's core product is its accounting software, QuickBooks, which today has an 80% share of the US small business market. Blast from the past there on the left, that's the very first desktop version of QuickBooks, launched in 1992 at a one-off cost of $140. In 2001, Intuit launched subscription-based QuickBooks Online, which over time has almost completely replaced desktop. Today, the most popular version is priced at $346, payable not as a one-off, but every year. Moving from a one-off cost to a recurring subscription payment offers a variety of benefits. Next slide, please. It reduces the cost of distribution and makes the product stickier as QuickBooks becomes embedded and invaluable to customers for, hopefully, multiple decades. It cuts out piracy. Although this sounds minor, you might be surprised to learn that according to the Business Software Alliance, 20% of all US software installations in 2010 were pirated copies. And once a subscriber is on the QuickBooks platform, they tend to pay more than a desktop user, not only because a subscription is more expensive, but because it's easier to add more optional paid-for functionality like payroll or inventory management. Between 2014 and 2022, QuickBooks Online's average revenue per subscriber increased 58%. Combined with the subscriber base expanding ninefold in the same 8 years, revenues from the product increased just under 14 times. So overall, this shift to subscription has resulted in an improvement in the quality of the business, far beyond an increase in the headline software cost. It has future-proofed the business and helped to generate exceptional returns for Intuit shareholders. Last slide, please. Other than an all too brief mention of the Rolling Stones, one Lindsell Train investment theme I haven't discussed is entertainment content. So I'd like to finish by showing you the incredible increase in value of a 30-second television advertising slot at the Super Bowl. Between 1967 and 2022, the price of a slot skyrocketed from $400,000 to a cool $7 million. We think it's a great illustration of the rapidly growing value of genuinely unique entertainment content. In our view, it's our portfolio company's ability to do exactly this, to continue driving up the utility, function, and value of their products and services, which will shore up their business models and expand their margins, ultimately protecting our shareholders against inflation and allowing them to participate in the really substantial amount of growth we believe these companies will enjoy over the longer term. Thank you very much for listening. Happy to open up to any questions if there are any.
Thank you so much for that. Very insightful indeed. I've got a couple of questions, some questions from the audience as well. The one question specifically speaks to one of your stocks, WWE. And the question is, if WWE is bought out or knocked out, will Lindsell Train look at relocating the capital among existing holdings, or has recent volatility awakened new ideas?
It's a question we're always thinking about. generally speaking, we look to the existing portfolio first to see if there are any opportunities to redeploy capital within it. That said, we've got a universe of 175 companies that we look at for global. Not all of those are investable at any one time, but those are the ideas that we do think about. So it's a question of timing. It's a question of seeing what things look like at that time period. Obviously, with transactions, when it happens, how it happens is uncertain. So that's something for us to think about then.
Yeah, if I look at your longer term history and track record, the feeder fund obviously a little bit shorter, but your actual fund's got a very long history, humongously big fund as well. You've served investors well. If I listen to your stock selection process, what you're looking at, exceptional businesses really delivering the goods over time, how do you deal with investors in a current environment that are so much more focused on short-term returns and doesn't necessarily always have the patience required?
It's the eternal question. The starting point has always got to be being very, very clear about what we're doing. I mean, you'll have noticed a lot of what I'm talking about in the presentation today, and the same message that we give in every client meeting, every presentation we try to do. We are long-term focused. I mentioned 20 years, Warren Buffett's forever, but in practice, at least 20 years, because that is genuinely what we're trying to do. And in a 20-year, 30-year time horizon, there will be periods of underperformance, particularly when you're so different from the index. It's inevitable, it will happen. And I think the best thing that we can do is hammer the message home, make sure that our clients do understand that is what we're doing and that it won't change. I think that's another really important message. We put so much emphasis on this because the investment process doesn't change. We're not, in response to periods of volatility or uncertainty like this, going to change the way that we do things. We've not done it in the past, we're not going to do it in the future. So having everybody that's on board with us understanding that that's the way we look at things and the way we do things is a really, really important thing.
Do I dare say a common sense approach, looking for companies where you'll find great earnings and they'll make clients money over time? It speaks to our next question as well, or comment from one of our audience. You are very different to the benchmark, which is the MSCI All Country. Now, if you look at your holdings, you know, it's a vastly different. So if you are looking for a global equity fund where there's a sensible approach in companies making good money for your clients over time, this is definitely a fund worth considering. Madeleine, we're unfortunately out of time. We are going to break for tea for our audience out there. Madeleine, from our side, our audience side, BCI team side, thank you so much for joining in this morning. And we look forward to engaging with you in the near future as well. To our audience out there, if you want more information on National Front, please get hold of the BCI sales team. And if you want a more updated information on their holdings and what the funds look like and where they're going, we can most definitely obtain that information for you. Madeleine, again, thank you from our side. We'll chat to you in the near future. To our audience, we are going to break for tea. We're a little bit behind time. If I may ask you, can we start at 10:30 again? So I'm stealing 5 minutes from tea, but luckily you don't have to wander too far other than your kitchen or your office kitchen to get a coffee and a quick snack. And we'll see you back at 10:30. Thank you so much. Right, Olga, thank you for that lovely music. I think we can get going again. It is 10:30, and thank you all for being back. We really appreciate it. Next up, we've got a fundsmith and a face or person you're all familiar with, Greville Ward. Greville, thank you so much for joining us this morning. I always have to ask you, since you travel the globe, and I see that lovely map behind you, can you maybe show us on the map where you are today? Greville, your mic.
Eugene,
Okay.
Morning to you. I could tell you where I am, but I'd have to kill you, Eugene, so probably better if I don't. I'm coming to you live from Fundsmith headquarters in London, which is somewhat important only because yesterday we held our annual meeting, Fundsmith annual shareholder meeting. We had about 1,200 people in the hall in London and Terry speaking. And the importance of that is that we will circulate, or we'll put a film of that up on our website in a few weeks when we edit it. So much as I'm sure you're all going to be fascinated to hear what I have to say, it's much more interesting to hear it from Terry, and that will be on our website in a few weeks. So anyway, that's why I'm in rather cold London and not warm Mauritius at the moment.
Fantastic. You always say, and we all know the story, Fundsmith, the fund manager that does nothing, but do you do nothing indeed? That's always the question. Thank you for your time, Greville, and we look forward to your presentation.
Fantastic. Thank you very much. Well, if we could appreciate you inviting me to come back. That was the disclaimer, which you read very quickly, and you'll see lots of those today. And if we can move on, the first slide shows the investment process, which I'm sure many of you will be familiar with by now. Only invest in good companies, don't overpay and do nothing, in that order for a particular reason. And we think the third of those is the hardest to do. The first is the most important. So I'm going to spend a few minutes on what we mean by good companies and where we might be able to find them, whatever the sort of macro environment. So if we can go on a slide. Sorry to start my presentation with a Warren Buffett quote, given that that happened in the last presentation as well. But this is very important. He says, I'm sorry to read it as well, but he says the primary test of managerial economic performance is the achievement of a high earnings rate on equity capital employed, without undue leverage or accounting gimmickry, not the achievement of consistent gains in earnings per share. And that's from the 1979 annual letter. The reason that's important to us is because what he's saying is return on capital is the measure that we and everybody else, he believes, should be using to assess whether a company is doing what it should be or not. And the problem that we have with earnings per share, and possibly him as well, is that if you give a company enough capital, it can produce any earnings growth you like. So we think that earnings growth or earnings per share is a measure that is much less important to us than return on capital. So we're looking for businesses with high returns on capital. If you could go on a slide, we're now going to look at a quote from Charlie Munger, his partner, who says, over the long term, it's hard for a stock to earn a much better return than the business which underlies it earns. If the business earns 6% on capital over 40 years, and you hold it for that 40 years, you're not going to make a much different return than 6%, even if you originally buy it at a huge discount. Conversely, if a business earns 18% on capital over 20 or 30 years, even if you pay an expensive looking price, you'll end up with one hell of a result. And so that's why our strategy is arranged in the order it is. Find good companies, don't overpay, do nothing. It's the finding good companies bit that's far and away the most important. And I think that a lot of speakers and Eugene have asked questions and spoken about short-termism. It's very difficult when the markets are perceived to be somewhat more volatile to try and look to buy things cheaply and sell them expensively, or buy low, sell high. But the best return that you get, we believe, from the equity market is finding good things to invest in and then just hanging on to them. And Charlie Munger is making the point that in the end, the return that you're going to get is going to be pretty close to the return of the underlying companies in the portfolio. So let's just move on if we can. Here is where we find good companies and not such good companies. So on the left-hand side, just using the measure that we've just been talking about, return on capital employed, you'll see that those are the sectors where you can find businesses that have generally high returns on capital. And we are invested in a number of those, as you probably know. On the right-hand side, with apologies to our friends earlier on who were presenting on banks and energy and other sectors, you'll see sectors that over a fairly consistent period of time, 2013 to 2022, have returns on capital which are low, and weighted average cost of capital which are high, meaning they're just not very good businesses to invest in. It's not to say you can't make money in those sectors if you're a swift trader, but that's not what we're looking to do. If you're looking for good businesses in good sectors, you're going to find them on the left-hand side of that screen in general. If we could move on, please. So returns on capital are also persistent. The third bullet point on that screen is the most important. Good businesses don't become bad businesses, or vice versa. And the chart on the right shows the 1,000 largest companies in the US, arranged by in quartiles, top quartile and bottom quartile, in terms of return on equity. And what you can see is that it fluctuates a bit, but essentially companies with good returns maintain those good returns. This is the chart from 1966 to 2011. Those with lower returns maintain those lower returns. So if you are a long-term patient investor, as we are, then you have to try and find those companies with high returns and make sure that they can maintain those high returns. And that's exactly what we try to do at Fundsmith. If we could move on, please. So this just shows the red bars at 1963 to 2004. So it's fairly sort of a long period. And then the gray bars in 1995 to 2004. All we're trying to show is over the long period and over a shorter period, the average return on capital for those sectors is pretty consistent. Industry with poor returns remain poor over time. Return on capital invested for return on capital in the better performing sectors, as the previous chart showed, is fairly consistent. And the last bullet point, being cheap or lowly rated does not make them good companies. And we think that's where some both private and also professional investors fall down. If we can move on, please. So that's what a bad industry looks like. That's the airline industry from 1994 to 2014. The red bar is the cost of capital. The gray bars are the return on capital. The most sort of striking thing about that is even in the boom years where everything's going as well as it possibly can, the airline industry is making a return below its cost of capital, which means it's a depreciating asset. So a bit like pass the parcel, if you own something in this sector, it is getting smaller every day, and you can buy it low and sell it high, again, if you're a very smart trader. But wouldn't it be better to own in companies that have returns significantly above their cost of capital, whatever's going on in the macroeconomy? So if you look at the next slide, which is IDEX, which is a veterinary testing company that we own, you can see those returns are very consistent. They've actually been growing very steadily in the last 5, 6, 7 years, but they're always significantly above the red bar, which is the cost of capital. And why is IDEX, why does it make returns which are that good? It's because we'll spend an unlimited amount of money on our pets. IDEX makes the consumables for veterinary testing machines. Testing on pets is more advanced than testing on humans because the dog can't speak. You can't tell the vet what's wrong with it. And so what IDEX makes is the stuff that when the vet takes a small amount of blood, puts it in the machine in the corner of his veterinary surgery, IDEX makes the consumables that then works out, what the blood is saying to the vet in a very short period of time, so the vet can say this is what's wrong with the dog or cat. Spending on pets is going up dramatically, both in the developed world and the developing world, and IDEX is far and away the market leader in those consumables, and that's why you get a pattern like that. But why not try and invest in companies that have returns on capital that look that good above their cost of capital? Isn't that a better place if you're a long-term patient investor? Okay, so the next slide is what the Fundsmith Equity Fund looks like. If you put all the companies together, we own 27 stocks today, put them all together, what does their return on capital look like? Well, it's pretty consistent from 2015 to 2022, although you had an unusually good year last year, but don't worry about that too much. On average, our companies have a return on capital of about 28, 29%, something like that, against the S&P average of 18% or the FTSE of 16%. They also have very good gross margins, higher gross margins than the indexes. We like gross margin businesses because it means they generally have pricing power in a higher interest rate environment. If the gross margins of our companies are 64, 65%, that means they're making things for 3.5 and selling them for 10. On average, in the S&P, companies are making things for 6.5 and selling them for 10. We like that higher margin. We like high operating margins as well, on average 26, 27%, higher cash conversion usually than the indexes, and higher interest cover. And that gives us tremendous feeling of comfort, whatever the macro environment is going to be, that we own a slate of very good businesses. Let's move on, please. The valuation of the portfolio, we look at free cash flow yield. Free cash flow yield of the fund is about 3.2 at the moment. The S&P non-financials is about 3.4. So if you agree with the previous slide, that we own a better slate of companies than the market, the fact that the fund is rated at about the same rate as the market, we would think is encouraging because we own better stocks in the market at about the same pricing level. And to us, we think that's a good trade, something we're very happy about. The free cash flow metric at the bottom grew at 1%, as you can see. The last reported period, our sort of rough guess what the portfolio is going to grow its free cash flow at in 2023 at the moment is about 11%, and the long-term average is about 8% for the portfolio. And that in terms of growth of free cash flow. Yes, please go on. Yeah. So although we're a buy and hold fund, we did get out of a few things last year. Several of these are execution issues. I'll run through them very, very quickly. Johnson & Johnson, we sold because they have a number of drugs coming off patent, and it's not obvious how the revenue from those is going to be replaced. It's a good business. We might own it again in the future, but while those drugs are going off patent, we wanted to get out of it. Starbucks, we think, has somewhat failed to compete with their competitor in China, and we think they're somewhat failing in the US as well. They had a few issues coming out of lockdown, which they haven't really solved, and they're struggling to hang on to their CEO. Coney in elevators and escalators, we like that business because of the servicing contracts. You'll see that on the left-hand side in the purchases, we bought Otis. So we did a straight switch. We sold Coney and bought Otis. Otis used to be part of a conglomerate, United Technologies, but then it became separately quoted. It's the biggest elevator business in the world, and we think has slightly better growth prospects than Coney, which is why we switched it. Intuit, with humble apologies to the previous speaker, who I know owns it and likes it. It's a good business, but we've sold it because they've made two, we think, strange acquisitions, MailChimp and Credit Karma. That's the first problem. We don't like our companies being acquisitive. And the second issue is that they use share-based compensation, and we don't think they account for it correctly. And we're distinctly concerned about that. So share-based compensation, Terry wrote about in the annual letter. If any of you have read that, Intuit is sort of a serial offender in that regard, and we're not happy about it. So we sold it, and PayPal have stubbed themselves stubbed their toe in a multitude of reasons, which we can talk about later if you wish. The purchases, we bought Adobe in digital publishing, Mettler-Toledo in weight. That's the the largest company in weighing and measuring. Everything coming out of factories has to be weighed properly, measured properly. And Mettler-Toledo is a fantastic company. Otis, we've talked about. We have a very small holding in Apple. We're waiting for the opportunity to increase that. We haven't liked Apple for as long as we thought it was just selling phones and products and computers and so on, because we saw what happened to Nokia in the early 2000s. But we do own it now because their service business is growing sharply. That is Apple Pay, Apple TV, the App Store. And we think that business, which is much more profitable and growing much faster than the devices business, is interesting to us. So that's what we did in 2022. If we could move on, please. This hasn't really changed over the years. I just put it up so that you can see consumer staples, healthcare, and old line technology, the three areas that we generally invest in. Lots of sectors that we'll never invest in, which you'll remember from the earlier chart. We'll never own banks, insurance companies, energy companies, utilities, media, things like that. But those three sectors, consumer staples, healthcare, and technology, are where we can find these high returns on capital, whatever's going on in the macroeconomy, and that hasn't changed much. And if we move on again, please, the geographic split also hasn't changed much, the USA being far and away the biggest weighting. That is just because if you happen to want to invest in healthcare, consumer, and technology, the biggest and best companies in the world are based in the US. But by revenue, you can see on the right-hand side, our companies are generating about a third of their revenue from the developing market. We don't really care where companies are listed or headquartered. And given that Fundsmith is a completely bottom-up process, it just happens that that's how the stocks that we own currently sit. But that also hasn't really changed much since we started. We've always had sort of between 65 and 70% in the US, again, because the three sectors that we generally invest in happen to have the largest companies headquartered and listed in the US. And if we can move on, yeah. So that's what this has all done for us. Last year was obviously a difficult year for any A, growth fund, B, fund that didn't own energy stocks, energy being pretty much the only S&P sector that had positive returns in 2022. Not unduly concerning to us, if we think we have a portfolio of excellent companies, all of which are growing a little bit every day, given the return on capital metrics we talked about at the beginning. We do think that. We hope that our investors are long-term investors. And if you look over on the right-hand side, we've been going for 12 and a bit years, produced a return of 15.5% in sterling against the market of 11.3. How have we been able to do that? Well, really because we think, if you go back to the quality slide we showed at the beginning, if you own better companies than the market and they're growing, then it shouldn't be an enormous shock that if you're a long-term investor, you should potentially get a better return than the market. So never good for the fund to go down, never good for the fund to underperform the index. But if you look at the last 2 or 3 years, and think of the Charlie Munger statement, the companies are not growing at 22, 23, 25%. So the fact that the fund in the preceding 3 years was up 22, 18, and 25 is clearly borrowing a little bit from the future. Maybe we gave some of that back in 2022, but we like stocks that we own. We're happy with the portfolio as is. And I think that's all I've got to say, Eugene. I think that's the last slide, and I'm happy to take any questions.
Great. Well, thank you so very much for that. A question from the audience, and let's deal with that very quickly. I have to ask, apologies for that. In April, May last year, Fundsmith was issued with the Section 166 notice from the FSCA. I want to check, has that matter been dealt with, and are you allowed, or can you now talk about it?
We're not allowed to say whether or not they came in to speak to us. And so unfortunately, we're not allowed to say whether or not they are, anything happened. But it is fair to say that, we are the largest fund in the UK. It would be strange if the regulator wasn't, keeping a very careful eye on what we do. We're regulated in the US, the UK, and in Mauritius, and in South Africa. And we're in contact with all of the regulators regularly. If a 166 notice was issued or a report was done, they usually take about 2 months to do. If there had been some major finding of that, it would have been announced publicly. I don't think you've seen an announcement. And I think that there was a press article published in, I believe in April, saying that the FCA had issued a 166 notice, that they'd done the report and nothing had been found that they were concerned about at Fundsmith. And I guess if that press report was wrong, the FCA would have said something about it, and they didn't. So I'm trying to find as many ways as I can to say that it's not something that we are worried about or thinking about.
Happy with that, and I think we can close that matter. If we look at the US business cycle, I mean, the US been in a massively long business cycle, probably for about 12, 13 years. We know the Fed at the moment is fighting the labor market to try and get inflation under control. We've seen some recent layoffs, not a hell of a lot, but the job numbers are still increasing. So there's still a long way of winning that fight. But do you think it could possibly be a threat to some of the companies that you hold in 2023 if the US labor market, the numbers would start to come down, and you would see some or potentially earnings contraction across the globe, or specifically the US, since about 48-50% of your earnings comes from the US?
It's certainly, yes, I mean, absolutely. But the reason that we don't use any sort of macro overlay at Fundsmith is because we know we can't predict what's going to happen. And so I'm going to read you, to answer your question, I'm going to read you something. So here's a quote. "Several times every year, a weighty and serious investor looks long and with profound respect at Coca-Cola's record, but comes regretfully to the conclusion that he's looking too late. The specters of saturation and competition rise before him." This was from a Forbes article in 1938. So that article was pointing to the fact that people were looking at Coca-Cola stock in 1938 thinking, damn, I've missed it. It's a good business, but it's not going to be around that much longer, or it's going to be competed away. And so, what's interesting is that we believe that if you own really good businesses that can make money, whatever's going on in the macroeconomy, because the returns are so significantly above their cost of capital, then sure, there might be some earnings contraction in the US. I don't think, we are big fans of the US because we think it's got an incredibly resilient economy. I don't think that there's going to be some separation where suddenly Asia or Europe does incredibly well and the US does badly. The US sort of leads the world in terms of economic growth. But we certainly are, concentrate on making sure that L'Oreal and Estee Lauder and all of the things that we own, Pepsi, have such good returns and have done. The average start date of our companies is 1924 in the current portfolio, 1924. And so whatever's going to happen in 2023, good, bad, or indifferent, we like where we are in relation to where we could be, which is in a whole load of highly priced, value stocks or something, firstly. And secondly, 2023 is 1 year. We're hoping that if you look at our fund over 7 to 10 year period, given what we own, we should be fine, whatever happens in 2023.
And I mean, obviously, you continue to look at the companies that you own and what the earnings is and return on capital as part of the process. Question from the benchmark, from the audience, relative to your benchmark, what are your parameters allowed in taking active bets regionally and per sector and so on?
I'm not quite sure I understand the question. I mean, comparing us to a benchmark.
How benchmark cognate are you, if
not at all. I mean, on the basis that we'll never own a bank, an insurance company, energy company, mining, oil, minerals, media, utilities, telcos, big pharma, mostly biotech. I mean, there are all sorts of sectors in this, that we will never own that are in the benchmark. So we only really invest in 3 sectors. We should never track close to the benchmark. I mean, occasionally we have, which is a huge shock to us at Fundsmith, but we should never track close to that. Honestly, if you want a benchmark, you should buy an index fund. Index funds are great. But if you are employing an active manager to do something, you've got to hope that they're not going to track the benchmark, because what's the point of paying them a fee if they are? So we're cognizant of it because we put it on our fact sheet every month, but it's not how we measure our performance.
Definitely, I fully agree with that. Greville, we unfortunately out of time. I just want to check quickly. I believe you in South Africa in May, where we host you at the BCI conference.
Yes, and your poor listeners and watchers will see some very similar slides and hear a very similar speech. I apologize for that in advance.
We'll have some more prominent questions for you then.
Please.
Greville, again, thank you so much for joining us all the way from London. We always appreciate it of your time, and we'll engage with you in the very near future. And looking forward to seeing you in South Africa in person for a change. Great stuff.
Thanks very much.
So much. Right, for our next session, we are on Sands Capital. We're going to show a recording from one of the fund managers. Sands Capital manage the global growth and global emerging markets growth funds. They are based in Arlington, just outside of Washington, DC, hence the recording, or the reason for the recording. It made connecting them live a little bit challenging, but the recording is from Brian Christensen, the portfolio manager and managing director, to share their views on long-term growth investing and how it all comes together in their funds. Joining online as well from their side is Ian Barnes from London. So time allowing, if we do have any questions, we'll try to take that, but we'll see how long the recording takes. And Olga, if you are ready, you can start. Thank you so much.
Well, thank you for that introduction, Eugene. So my name is Brian Christensen, and I'm a co-PM on both our global growth and our emerging markets growth strategies at Sands Capital. For those of you who may be a little bit less familiar with Sands, we do one thing, and that is we are active long-term investors in leading innovative growth businesses around the world. So one of the ways to think about what we're trying to accomplish is that we have a singular focus on growth investing, and we're trying to identify that truly select group of businesses that can grow for much longer and for much faster than the market anticipates. And then when we find those, we want to own them at meaningful weights and for much longer periods of time. Our headquarters is in Arlington, Virginia, right outside of Washington, DC. And then we have 2 other offices in London and Singapore. And we have approximately 44 billion in assets under management across a handful of our flagship strategies, with our private equity strategies on the left, focused on earlier growth stages across the growth spectrum, including venture and mid to late stage private growth equity strategies, all the way to our right, which is our flagship public equity strategies, where the bulk of our assets reside. So for our time together today, I wanted to reflect on some of the challenges as well as the forward-looking opportunities that we believe the current environment is presenting for investors like us that are focused on these enduring secular growth businesses during a time of what we have described as a distortion and a doubt. So I obviously don't need to go into detail with all the things that we've been, experiencing and which the financial markets have been trying to absorb, but it is helpful to actually sometimes zoom out and just look at the confluence of factors that have been impacting financial markets over the last year or so, whether that's the rising inflation and interest rate cycle, or the pullback in some of the world's largest government stimulus spending in history, the paring back of the Fed balance sheet, concerns around the short-term China macro backdrop with the property sector, or the long-term trajectory given the trend towards deglobalization between China and the West, and the breakout of war on the European continent, and the aftermath of the pandemic. All of those things have come together to create a significant amount of not only volatility, as the overall equity markets have demonstrated, but also, as we'll talk about, it's contributed to the doubt and the distortion that we've been seeing. So we've just lived through what was a very challenging period for global equities in 2022. It was not unprecedented. If you take this data series, for example, which goes back almost a century, in the last 100 years, you can see that there are other periods where the S&P 500, just as a proxy, because it's some of the longest data series we have, there are other periods where we've had a more significant drawdowns. Nonetheless, this was the 7th worst year for US equities in that nearly 100-year period, just to put things a bit into perspective. And then the pain was particularly pronounced in the growth equity universe, where if you take the top 5 worst quarters of the relative performance between the MSCI ACWI Growth and the MSCI ACWI Value, since inception for those two indices, so the data series starts in the late 1990s, you can see that 3 of the top 5 worst relative periods for growth versus value all occurred last year in 2022. So we saw a very severe rotation from growth to value, which is observable here. But one of the things that perhaps is a little bit less observable for some folks is the fact that we also saw a fairly severe rotation between different types of growth businesses, and or within growth, I should say. And what I mean by that is it was actually the fastest growing businesses by revenue and or profits that often saw the most significant valuation and stock price pullbacks versus the more classic growth businesses. And the natural question is, what are some of the things that led to that? There's obviously been a lot of talk about the inflation and interest rate cycle. And one of the things that we'd point out is it's not actually the fastest Fed tightening cycle in the central bank's history. It was actually faster in the 1970s. But it is the fastest or steepest slope of the curve that we've seen in over 30 years. And when you take all those macro considerations, one of the things that we think it's very important to do as fundamental investors is actually put yourself in the shoes of an actual operating business and sort of determine how do those things actually impact what it's like to run a business on a day-to-day, monthly, or quarterly basis in a period of a relatively historic volatility. And that's what this slide is really meant to illustrate. What we did is we took US retail sales on a monthly basis over the last roughly 30 years, and it shows what a normal business cycle looks like. Those are monthly periods where maybe your demand increases on the upside in the low to mid single digits, and on the down part of the normalized business cycle in the negative low to mid single digits. And then you have a couple really, bigger macro cycles in the early 2000s or the financial crisis where, that upside and downside volatility in terms of aggregate demand for retail sales for any companies that are selling in to the U.S. consumer. You see a higher level of volatility, but still within the relatively sort of normalized range. And then you have the pandemic on the right side of the page, which just shows that the volatility in aggregate demand that we saw was way above the normal standard deviation. And it was like that for a fairly meaningful period of time. And what that essentially did, in short, is it became increasingly difficult for businesses to operate. So think about a restaurant or a manufacturer or a service provider that's trying to figure out, whom and how much to hire, trying to figure out how much to invest in inventories, or if you're a public company, to provide guidance to the public stock market investors. This environment translated into far less visibility, not just into trying to predict the long term, but even what your short term demand outlook looked like. And when there's that much volatility in the short term, what happens is investors shorten their time horizon, and it makes investors far more risk averse. And it creates a risk off environment where investors are unwilling to pay the same multiple per unit of growth, given that visibility is so much lower. In addition, because of all of the distortions that sort of made it more difficult to parse out the short-term noise from the long-term secular trends, investors began to question some of the long-term opportunities for many fast-growing businesses. So what we mean by that is, take some of the biggest technological shifts or penetration stories that we've seen over the last, number of decades, and look at their penetration curves just using U.S. household penetration curves. And what you really realize when you zoom out in this data is that, these penetration stories aren't always just up into the right charts. Not only are there periods where the penetration curves decelerate, but there's actually parts of the business cycle where year over year, these penetrations can actually contract. And when we enter a period like that, what happens is a big investor debate often opens up of, within that penetration curve, are we about to face a growth wall where we're seeing a peak penetration for that particular technology? Or is it just a blip on the long-term path? And one example of that is, so we took landlines, which is in the blue line, cell phones, which is in the red line, social media, which is in the light blue line, and then Netflix subscriptions, which is that teal line all the way over to the right. And so we took each of those, and really one way to illustrate our job as growth investors, again, with 30-year track record of trying to develop pattern recognition on these secular growth opportunities to be to get what we hope the vast majority of these businesses correct along their long-term path. But it's our job to identify, is it a blip on the way to further penetration, similar to the landline in the 1930s, or cell phones or social media usage, for example, or is it a trend that may be truly in secular decline, sort of like where landlines were in the 2000s? And so when you take something like Netflix and where we are in the over-the-top penetration story for online media consumption, those are the types of questions that we're asking ourselves. The really good news is that when you can identify a business that is undergoing a short-term blip, and there's a concern by a portion of the market on whether or not that's negatively impacting the long-term TAM, and you're right that it is a short-term blip rather than a growth wall, that can create tremendous opportunities as growth investors for wealth creation over time. This is another dynamic it's sort of a fundamental dynamic that we've been seeing as we've been exiting the pandemic. We can see what we sort of call this bullwhip effect. It's been particularly pronounced within some of our digitization businesses, for example, where we had this rapid expansion phase where revenue growth actually accelerated in the first half of the pandemic. You can think about businesses that enabled shopping from home, digital connectivity or business productivity tools that were online, or online entertainment related opportunities, or cloud infrastructure. All of those things really saw accelerating demand curves. And in many cases, that accelerating revenue actually outpaced the company's ability to catch up with investing in expenses to meet that demand over time. So you saw a significant margin expansion. Then as those businesses started ramping up their investments to meet that demand, what happened is we started to see a slowing of the economy. You had more difficult comps year over year coming out of the pandemic. You also had the higher interest rates starting to put a brake on some economic activity. And that led to a period where actually margins began contracting. And in 2022, the market sentiment also shifted. So the market began punishing companies that prioritized growth over profitability. And that was actually a reversal over the previous decade, where many companies were actually rewarded to gain market share, have a winner take all opportunity, and actually top line growth was rewarded over profitability. All of that really began to shift in 2022 with the rising inflation interest rate cycle. So now companies have been going through a reset period. They're reacting, they're pulling back on spending, right-sizing their cost bases. And so then the natural question is, what comes next? And what we would assert is that with a higher cost of capital in this new sort of market regime, that we're going through or likely to go through a period of industry rationalization, where those companies that have truly in-demand products and services, and they're offering them with structurally positive unit economics, those companies are not only poised to survive this period, but we actually think they're positioned to thrive. And the way we identify those businesses is that we believe they're typified by our 6 criteria. Companies that have very visible growth drivers, layers of competitive advantage, strong management teams, the balance sheets to invest throughout the difficult part of a cycle to come out stronger. And like I said, not only survive, but thrive on the other side of this industry rationalization phase. Again, that's another way of sort of thinking about some of the challenges that have faced some of these businesses and stocks, but actually the opportunity that it's creating going forward. So if I was to wrap sort of some of these concepts together with our investment philosophy and process and our beliefs, the way I'd frame it is this. Linking back to what I said in the beginning in the introduction is, we believe that if you can identify a select group of businesses that can defy the laws of mean reversion and grow for much faster and longer than the market anticipates, in other words, compound earnings at a very attractive rates over the next 5, 10, 15 years, those stock prices can have a tremendous amount of volatility in the short term and be driven by a lot of things other than earnings on a 1-year basis. And we're living through a period like that. But if you zoom out on a longer term period, we believe that that compounding of true earnings growth is actually the primary driver of long-term stock outcomes. And so by identifying the best that we think can grow faster than the average for much longer periods, we're actually willing to accept that short-term market volatility because we think market volatility for a high quality, long-term growth opportunity in business actually creates opportunity. So we're viewing this period, obviously it's been very, very difficult from an investment results perspective being a growth investor, but if anything, we're viewing it as an opportunity to identify businesses at even more attractive prices. And we think that there's a very a positive setup going forward from here. Another dynamic that we talk a lot about internally is that we think it's a bit of a fool's errand to try to time the market. And one of the reasons for that is that the financial markets tend to trough well before actually the economic growth cycle does. And so what I mean by that is if you wait for the all clear sign and for all the headlines to improve, for the official GDP reacceleration data to come out, typically, and again, we sort of pulled a half a dozen different recessions and mapped the GDP data relative to the S&P returns. You can see that the financial markets tend to react well before the actual economic data, and that's because the financial markets are a forward-looking discounting mechanism, and they don't really wait for the all clear sign. They wait for the light starting to shine at the end of the tunnel, and so we're not market timers. But what history has at least shown us, and by history I mean, our history as well as the history of studying, long-term financial market data, it's that 1, 3, and 5 year periods following troughs in consumer sentiment tend to be, very strong periods of, forward-looking returns for the market. And most recently, this is some consumer survey data that has one of the longest 10 years, or I guess data series in the US, which is the University of Michigan's Consumer Sentiment Index. But essentially, we've reached another trough in consumer sentiment. And what's interesting is those troughs have often been signals of forward-looking periods of strong investment results for the market. So, switching to our portfolios themselves, and sort of wrapping up with some conclusions here. If you look at the global growth portfolio since inception, it's been fundamentals that have driven all of our returns since inception. And so you can see the overall returns that are cumulative in that blue shaded box. You can see the EPS growth at the portfolio level in the dark blue line. And then you can see the contribution related to the PE multiple to returns. And one of the ways to interpret this is that not only have fundamentals driven our long-term returns since inception, but you can actually see that the bulk of 2022's drawdown that we experienced last year was actually driven by multiple compression rather than deteriorating fundamentals at the portfolio level. And we think that's interesting because that means that because of our very low portfolio turnover, we own largely the same portfolio. We think those portfolio businesses is very well set up to deliver attractive earnings going forward, and at even more attractive valuations, given that it was really primarily a PE-driven valuation pullback rather than worsening fundamentals. Another thing I would say on this slide is you can see that the 2010s, that decade was very good for growth equities, including ourselves. And while we did see some benefit from PE contribution, during that period. It was never really the bulk of the driver of returns from that period. So looking forward, we also don't believe that we're likely to be significantly penalized from here going forward, even if it's a value-driven market from a PE multiple perspective. We think what really, really matters for us is getting the magnitude and the trajectory of EPS growth correct for the majority of our businesses going forward. And if we do that, our investment results are very well set up. And this is the same, a story that rhymes with emerging markets as well. So that same dynamic of EPS being the long-term, driver of our stock price returns rather than multiple contribution since inception is also true. And the fact that the bulk of the drawdown last year was also driven to PE contraction rather than a deterioration in the fundamentals. So stepping back, for both our global and our emerging markets portfolios, we're projecting earnings growth in the 20 to 30% range at the portfolio level over the next 5 years. And that's in line with what we projected and what they produced historically. There are upside scenarios where they could even grow faster, given that there's a focus on margin expansion, and many of these businesses are asset-light businesses that can scale fast and drive better unit economics and actually drive earnings faster and revenue growth over the next 5 years. And under most realistic PE scenarios, we think that level of earnings growth, even without any multiple expansion, should lead to a very strong outcome. And we think it's highly unlikely that we see another 50% PE decline from here over the next 5 years, similar to the reset that we saw in 2022. So finally, I wanted to end on how we think about Sands Capital and its ability to deliver on its mission and how we measure that. So our mission is to enhance the wealth of our clients with a prudence over time. And the way we measure that is our ability to outperform the relevant benchmarks over longer periods. And if I zoom in on that 5-year period, that's the one that we're really trying to optimize for, is that rolling 5+ year period of investment results. You can see that we have an exceptionally strong hit rate of outperforming on a rolling 5-year basis, both for our global growth portfolio, as well as for our emerging markets portfolio. And I just wanted to thank everyone for being in the audience today, and hopefully those remarks not only put into context some of the challenges that investors, and particularly growth investors, faced in 2022, but also the opportunities that's creating, both from a fundamental perspective and a valuation perspective, when we're looking at opportunities going forward over the next 5 to 10 years.
And thank you very much for that. We are very much out of time. I see Ian is online. And Adam, thank you for that question that you sent through in the Q&A box. Ian, I see you've already responded to that. Any of our audience, if you have any more questions for Sands Capital, please direct it to Ian. He'll be more than happy to take that. And if you want to know more of the funds or the process, we are more than happy to get you in touch with either Brian or Ian. Ian, from my side, sorry, we don't have time for any more questions, but thanks again for joining us all the way from London. You get to know who's in the audience, and our audience out there, at least you got to see Ian, and thank you for that. Right, we are going to continue with our session, and next we have GQG Partners, a well-established asset management company based in Miami, Fort Lauderdale. Forward-looking quality is their dynamic approach to quality investing. Joining us now is Shalante De Silva, Senior Investment Analyst at GQG Partners. And also online is their South African partner, and also the company through which you can access GQG funds. On the line as well is Gideon Nieuwoud from Southern Right Capital. They have 2 feeder funds here into the GQG funds, and it's called the Southern Right Capital BCI GQG Emerging Markets and Global Equity Feeder Funds. A whole big mouthful there. We will circulate those fund names afterwards to the audience as well. Jolanta and Gideon, thank you so much for being online with us. We really appreciate your time today. And to our audience, again, if there's any kind of questions, please direct it in the Q&A box, and we'll get that through to our speakers as well as Gideon.
Thank you very much, Eugene. Good morning, everybody. We will try to make the best use of a short limited time today, but maybe I can kick off by saying investments is about being on your front foot. And if you look at the statistics here about GQG, we've had this conversation the first time with this audience about a year ago. And although we've been through quite turbulent markets, the business at GQG has been stable and ever evolving. So today, the business sits at about and just over $90 billion of assets under management, which is quite sort of almost equally spread between the emerging markets strategy, the global and the international. The US equity strategy has also been a growing strategy. From the investment side, Rajiv Jain, the CIO, who's got a track record spanning north of 30 years, is still leading the investment team, supported by 2 deputy portfolio managers and a very senior investment team that's been also stable and evolving. So Jolanta De Silva, who's with me on the call today, he's been with GQG since outset. The business was founded back in 2016, as a reminder. Rajiv Jain ran the equity strategies at Fontebel for the previous preceding almost 25 years. And I think one would be amiss to talk about what's lying ahead of this year if one don't have a quick look at where we were coming from last year. So just a quick note here on the performance of last year. I hope this is visible enough. Let me see if I can add a bit of size to it. So if we quickly have a look here at the Global Equity Fund, which is available on the BCI platform through the South African Rand feeder vehicle. The Global Equity and the Emerging Market Equity Fund is the Southern Right Capital funds that's in South African Rands, but one can also access this globally through the UCITS structure. So last year, one have seen significant outperformance there in US dollars, which was 14, almost 15% on the global strategy. And if one look at the longer dated numbers since inception, 500 basis points of outperformance here since inception. And Jolanta will talk about how that outperformance is being achieved when one have seen several different market conditions, anything from wars and movements in China and all kinds of instabilities. But the message here is we're coming from a track record of outperformance, a track record of stability, and a track record of being on the front foot. With that, I will hand over to Jolanta, who can talk a little bit more about the performance last year, and also we've included the most recent performance here. I'll hand over to you, Jolanta.
Thank you, Gideon. If you could take me to slide 6, please. Just to follow on to what Gideon talked about, which is what we delivered last year. One thing about GQG, we keep up in markets that do well across the board, which was 2021 and 20. And in challenging markets is where we come out much stronger because of our, call it the quality underwriting process and the forward-looking quality underwriting process. 2 big pivots we made last year that really defined this. One was increasing our exposure in 2021 into energy. And in a similar period, we reduced our technology exposure, right? Our technology exposure was pulled back because it is clearly evident today that there was a massive pull forward effect. And the question was, if that's the case, right, and this pull forward took place after a period of reasonably buoyant spend pre-pandemic, and the markets are assuming that these stocks are going to see pandemic-like spend for perpetuity, right? So you had exaggerated valuations. You have to respect the risk of paying multiples at those levels and making those broad assumptions. And generally, when you see a reversal, you go below trend before you return back to trend, right? That was our concern. Valuations were heightened. And then we have this very unorthodox risk management / underwriting process through a roster of non-traditional analysts that sit in-house at GQG. So we have investigative journalists, we have accounting specialists, we have capital structure of fixed income, quasi-fixed income underwriting, we have disruption specialists, right? These folks are layered on top of what the fundamental analysts do. So we tend to get a very diverse perspective on all our businesses that we look to own through full market cycles. And this is where the journalists provided some incredible insights that gave us more conviction to step away. We're looking at an industry that was growing faster than they've ever had. The raw material for technology is brain power or manpower. Q1 of 2021, we started seeing red flags, right? These journalists are active talking to recruiters in the blog ecosystems. Recruiters started telling us about how candidates that are deep in conversation, their conversations just died off. Then by Q2, Q3, we hear about offers getting rescinded. And Q3, Q4, tech companies were the largest recruiters. They had their internal recruitment teams. These teams started getting disbanded. This didn't connect with the top line revenues that we were seeing, the buoyancy that we were seeing in the markets. In lieu of that, because beneath the surface, there was clearly problems. We didn't go from Uber hiring to mass culling, right? The market started reflecting this risk, I would say, mid-2022. So there were close to 15 to 18 months of data points that one could have responded to. See, we make money by detecting change, right? Not just sitting put and owning the same old franchises, right? There is a clear shift. And what we're concerned about even today in technology is that while we've seen multiple contraction, we haven't seen the earnings cuts reflective of the pullback and the reset back to trend. And so this is where we're in a pause mode as per our current posture. We didn't respond to the short-term anxiousness the markets provided last month, right, on the expectations of rates rolling over, and clearly it's inflation stickier, and therefore the heightened rate environment will probably last for longer, which is a structural risk in terms of how you underwrite businesses, right? Markets were very comfortable paying up for multiples of sales. Today, what we focus on is multiples of free cash flow. We have become extremely, I would say, stingy about ascribing high multiples for businesses, right? And what we're aiming to do is to deliver high single, low double-digit total return through a full market cycle at the lowest possible multiple. And this is thus the reason that we're able to defend better in volatile or downdrafts, which matters more because that's how we compound at a higher rate through the full cycle. So we generated 15% outperformance in the most complex of market periods by taking outside bets in areas that a traditional growth manager wouldn't. And let me now explain to you what we look for as a quality growth manager, right? Because quality is not a static characteristic, and quality exists in every sector, right? 3 core tenets. First, businesses with very high barriers to entry. And what I refer to a barrier to entry is what is the moat of the franchise out 3-5 years. 2, these are companies that have proven resilience through full market cycles, even meaning in a down market, you've seen earnings hold up either on relative or absolute terms. And 3, we're in the large mega cap space. Despite the size and scale of these businesses, they still have substantial headroom to grow. And I would look at our energy exposure, which epitomizes that concept of forward-looking quality, right? We're looking at energy companies that are in a position today, they have assets that are irreplicable, balance sheet transformations. These are companies, take Exxon, for example, barely made money at $100 oil in the last cycle, 2013-14. Today, at $50, Exxon's making good money because lifting costs down to 35, headed to 25, right? Massive efficiency gains. Our base case is $70. At 70, Exxon will double its earnings over the next 4 years. And this is without production growth, right? This is purely efficiency coming through. At prevailing oil prices, most of these oil majors will be net cash in a similar period, right? And by the way, this is the moat of Exxon today is looking far superior than what it was a decade ago. And the moat of Exxon out 3-5 years looks even better because the regulatory challenges of adding capacity are only going to intensify, right? And this is not just a view from GQG in terms of the quality aspect of a business like Exxon. The beta of energy today is down by 50% from 12 months ago. Tech has a higher beta today than energy. And this is a reflection of improving earnings visibility in a particular sector, aka energy, and deteriorating earnings visibility in another space, right? But if you zoom out, what you've seen is a sector that has seen massive underinvestment for decades, which is now being able to, anytime you have too much money going in, you tend to have returns degrading, which is technology. And any place you have underinvestment, you seem to see more secular improvement in the return profile, which is energy, right? So even if you want to put a new semiconductor fab, I mean, you probably get it off in 3 to 5 years, right? Just imagine if you're trying to drill somewhere, you'll be lucky to get the permissions in the first 5 years, right? Even Saudi Aramco, which makes $45 billion of net profits a quarter, have only committed an incremental 1 million to 1.5 million barrels by 2027. That tells you how acute the environment is, right? Now, I don't want to, make energy sound like a secular consumer staple business. This is still linked to a single commodity, which is linked to GDP. So you can't divorce it from economic growth, right? But this means that we have to have a heightened amount of vigilance when owning this sort of sectors. But the backdrop of this current posture is that we have a portfolio that is cheaper than the index, that is yielding higher than the index. But we haven't compromised on the quality factor. We are sitting there at index or higher in terms of return on equities. And we're getting this risk at a 0.7 beta, right? So much lower risk to get the growth and quality that we're able to pick up today. And this is the disconnect we're seeing in the markets because many folks still try to play to the old playbook, and while the market environment has seen a drastic shift, right? And today, energy looks a lot more secular and far higher quality than it has ever been. Now, sort of pivoting over to emerging markets, right? we have a very differentiated posture. Now, to give you our conviction on emerging, the EM exposure in our global fund is sitting at the max limits that we can get to. We had this sort of level of EM exposure about 5 years ago, but it was very different ownership. The majority of our ownership 5 years ago in emerging within our global fund was China. Today, we have zero China, right? What we're seeing is substantial earnings opportunities ex-China across emerging markets, and that's what we've brought in to our global portfolio, right? The emerging backdrop, I mean, it's quite unique. We haven't seen this before, right? Mexico has lower inflation than the US. India has lower inflation than Europe, right? EM, by virtue of where the resources sit, is over-indexed to materials and energy. Therefore, sovereign balance sheets are healthier. Before one single rate hike in the US, Brazil had hiked rates by 1,000 basis points. So we got monetary flexibility, right? Even China, we're looking at 5% growth. India, 6, 7, Indonesia, Brazil. So substantial amounts of opportunities within an EM context that we're seeing. And that's getting reflected in terms of our EM weights within global. So quite optimistic on the emerging market side, right? Our debate, and we have a underweight to China, given the fact that it is very challenging to decipher common prosperity, right? You can own a business like Alibaba, but it's a company that is in the crosshairs of government regulation, and it's not. I can't imagine it's a good thing that the government is considering or is going to take a golden share class and have a board representation, right? And if your largest consumer tech platforms today are not operating to optimize to profitability, it's a drag on the entire sector, right? Even companies we've owned, and by the way, we've owned every one of these businesses, right? But the regulatory intensity is the big unknown, and therefore we cannot ascribe a sustainable growth number. And then if that's the outcome, how does one put up a multiple to any earnings that you have no comfort on? And so therefore we have decided to get Chinese exposure or Chinese growth, but without the domicile risk. And so we have this optical underweight, but are we really underweight if we have 20% energy or 20% Brazil, right? Or 10% material. So we do have substantial indirect China exposure, and that's reflective of the uncertainty that we see in terms of the earnings footprint of some of the largest businesses there. So let me stop there. Gideon, feel free to add anything that I might have missed. But happy to take questions on either one of the portfolios.
Jolanta, thank you very much, and Gideon as well from our side. From the audience, we are going to move on. We're a little bit out of time, but Jolanta, if you maybe stay online, there might be some questions from the audience. You're more than welcome to post it in the Q&A box, and we can get you in touch with either Gideon or Jolanta as well. Just a reminder, Gideon and his team is based in South Africa and super keen to engage with you all. And GTG has a solid track record and most certainly gives clients some very different opportunities than what we are used to, well worth exploring further. Jolanta, again from our side, and to Gideon, thank you so much for joining us all the way from Miami. We really appreciate it of your time, and we look forward in engaging with you in future. And again, to the audience, if you have any questions, you're more than welcome to post it in the chat box. Right, we are going to move on. Joining us now is North Star Asset Management, And we welcome Adrian Clayton, the Chief Investment Officer at North Star Asset Management. And I believe, Adrian, you are joined by your colleague as well, Donovan Stefan, as a Senior Analyst. I think is on the line. Yes, on the line as well. They are going to share the global outlook and what they have to offer. And maybe just a short note to the audience. And from the BCI side, we're very excited to announce that North Star will soon join the BCI family. And we're really looking forward to hosting you and engaging further. Adrian, thank you so much for your time today. We really appreciate it. You're also based in South Africa, so you're in Cape Town, I believe.
We are. Thank you, Eugene. Thanks for the opportunity.
The slides is ready to go, so if you are ready, we can start.
Thank you very much. And thanks to the audience for listening. Hopefully we'll give you some insights. Really, the topic is around our view on global markets. And I think as we go through today, you'll get a distinct view on what we think is happening out there and the positioning of the funds. Just before I start, really, I'd like to say that, we've been at this for 10 years at North Star in terms of our global capability. And we had a plan 10 years ago to build out this capability at the company. And I think you can see the infrastructure through the presentation will demonstrate, what we've managed to build. And it hasn't been an easy task. And we're obviously competing with some of the global giants. Sorry, I'm just moving it. All right, so just what we're going to discuss. How important is global exposure? We thought we would cover that. Some macro forecasts, building blocks for success, how we really did it over 10 years. What capabilities do we have to have at North Star, and just a little on our investment team. All of which hopefully will cover the point as to what we think is going to happen in global markets. Just in terms of, I think this is a generic kind of slide, but it is important for all of us in the financial services industry in South Africa. Before just diving into global, how important is it really? So our quants team ran some numbers, looked back at various standard deviations across sectors in South Africa, and try to work back over long data series as to what would an optimal global asset allocation be. Of course, looking at other asset classes too. So this slide is available, anyone can have it. But effectively, from low risk right up to high risk local equity portfolios, you can see the standard deviation in light blue. And then it tries to optimize to see what kind of asset allocation one should have and how much global you should have. And quite frankly, with the latest Reg 28 changes, our work shows that just in the high balance sector in South Africa, where there is a lot of money, high equity balanced, the global exposure should be as much as 40%. So not far off the 45% that's now been dictated by Reg 28. And that just gives it to you graphically. For lower risk strategies, slightly less global, and then for very, very high risk strategies, you'd be defaulting more to South African equity, simply because South African equity has outperformed global equity in rand terms over time. But what's important is that the mix of global and local depresses volatility. So you find there are often different correlations there. And there's an optimal number. And in the Reg 28 space, that's about 40%. Now, just in terms of forecasting, and I don't know if you know that old joke, but there's economists are the only discipline where two people can win a Nobel Peace Prize, but have completely different views on something. And really that's maybe defined in terms of these slides. So what we've shown here is is US unemployment on the left-hand side and consumption expenditure. And what it's trying to tell us is that when unemployment's at all-time lows, that's the economy is obviously pumping ahead. When it's at all-time highs, we're often in a recession. Those are those light blue bars. But of course, you would be a raging, very positive about markets, a raging bull in the current environment. You've got massive consumer expenditure. Consumers are wilting down a huge amount of cash that they built up during COVID. And unemployment rates are at all-time lows, both in the US and in Europe, which is a bull sign. And on this basis, you would want to own the markets. Equally, we're starting to see inflation tapering off in certain areas, specifically in the goods sector, less so in services. But you can see container prices, which are a big issue during COVID, coming off. And on the right-hand side on the graph, you can see natural gas prices are levels lower than they were pre the Ukraine invasion. So clearly disinflationary, again, particularly good for markets. But against that, what we can show here is that the US savings rate on the left-hand side peaked out in the midst of COVID. So households were saving up to 35% of their disposable income. They had a huge kist of cash, and they started spending. That's why that blue line's dropping. And that's fueled the economy. But what we can now see is that starting to turn up again, and savings rates are starting to increase, which means, in a nutshell, that people will be spending less. And the view, a lot of market commentators feel that the cash hoards will be running out in Q3 and Q4 of 2023. So, the tailwinds for the market might start to disappear. And on the right-hand side, we just show money supply and really, let's call it, it's PMI, Eurozone PMI, which is effectively an economic indicator. And when money supply is dropping, economic activity drops off too. So both of these graphs are actually quite negative for the market, and you'd be selling. So quite frankly, if you look back over time and you look at some of the greatest commentators, there's been a consensus view that you need to have a deep understanding of the companies you invest in, as against spending too much time on macroeconomics. And we've already put some of the greatest thinkers in here. You've got Ben Graham and Howard Marks and Warren Buffett and Charlie and Templeton. You can see their views on the importance of understanding the businesses you invested in, rather than spending excessive amounts of time, as we showed in the previous graphs, trying to understand macro cycles. So really, how does one manage money and get it right over time? And we feel that what you need to do is have a strong fixed income capability globally. You need to be able to select stocks, which we show how we do that in the presentation. You have to have very strong asset allocation capabilities, and you have to be able to compete in both the fundamental space in terms of stock selection and have a very strong quants basis. Now, we say that because the market, clearly you're thinking about AI and smart beta and that kind of stuff, which is many people feel overwhelming, kind of the alpha area of the market. And we believe these things coexist, and we should have both skills inside our business. So we've got a lot of quant stuff, and we equally got a lot of deep fundamental work. So those are kind of the building blocks of how you get it right globally, and the things we focused on for 10 years. The long and short of it is that you end up with hopefully a good long-term track record in the global space. So let's just stick to the fixed income. I'm not going to bore you in how we do fixed income and all the modeling and that. I mean, you've probably been sitting through hours of graphs on that. But the long and short of it is, what's the outcome? And here on this slide, we're in light blue, and I think it's best summed up by Citywire that wrote an article in January, who the top 4 best real fixed income managers in South Africa. And ironically, none of them are big names. And you can see on the far left, from all the work they did in terms of various benchmarks of performance and how managers have done over multiple years. So we can show a 7-8 year graph in the fixed income. We're just showing 3 years because most people look at 3 years. On a risk return basis, the managers that have performed the best have actually been MyPlan, Grenade, Amplifier, and Northstar. That's what their work revealed. And so the first point is, you've got to be able to do good fixed income work globally now. And this is our fixed income capability in South Africa. We've been doing it globally for 10 years anyway, but obviously we haven't run a global fixed income fund, which I've just launched now this next month. All right, in terms of that fund, I'm not going to go into the details of it, but it'll be a dollar-based fund. Current yield expected to be about 4.2%. And we have a large grouping of asset classes. In this instance, we'll also have some equity because the global markets allow us to do, and our South African income fund has no equity exposure. But 4.2% yield in dollars, in our opinion, is quite juicy. And that just gives an indication of what's available out there these days. So the first point I raised was, you need to have a fixed income capability. The second is a global equity selection capability. And again, this is a complex graph. I don't want to go through it in detail. But what counts in our world is the buy list that sits in the middle and how we construct that, how we actually how we build up that buy list. So we screen companies on specific measures. There are about 1,180 companies that we screen globally. We tend to focus on very specific criteria over long periods of time that we look for in businesses. And we try and create a smaller list of about 250 companies that we know well. So our research team tends to be very involved in understanding those businesses. We build models on them. We have a full valuation. We put out a fundamental research report on that company. And if it's good enough, it makes its way to our buy list. The valuation work is very, very important, and you'll see it come through in the presentation as it has an effect on our asset allocation work. But the buy list dominates everything we do. No one at North Star works on their own. We all work towards inputting information into our buy list. Now, just how that buy list works, and again, not wanting to go into any detail, but I've just pulled out just two stocks that are in our global buy list, and it's Visa and Estee Lauder. You can see on the left-hand side, we indicate the weight in our portfolios, the risk level that was voted at an investment meeting by our full research team, the date that we researched it, the highest entry price that we can go into those stocks, the actual share price currently, and note out of interest that the share price in the case of Estee Lauder, in our view, exceeds the highest entry price, whereas in Visa, it's still an option to buy it. As we move to the right-hand side of the list, there's a bear case, a bull case, a base case for every stock, a probability-weighted intrinsic value that we construct, as well as a bear case and base case and bull case for our entire buy list. Now, why this is important, and I'll explain it to you, is that when you've got a long data set, 10 years, you get a very good idea when to buy the market and when not to buy the market by looking at the discount to intrinsic value. So in a nutshell, if we think we know what each stock is worth and we know it's trading at currently, we can get a view of the difference between what we think it's worth and what it's trading at. That will be a discount or a premium to its actual share price. Considering we have, call it 100 stocks on the buy list, global buy list, we can then work out a weighted average discount that the whole buy list is trading at. So if that discount is enormous, then it gives us an opportunity very mechanically to buy the market. When that discount is very small, it tells us to sell the market. So just in terms of our global equity capability, on the bottom left-hand side, we removed all the manager names, but in the top, you can see it says North Star Global Equity. That is the carve out from our flexible fund, our dollar-based flexible fund in Ireland, and it's the equity exposure and how we've done against the top peers in the world. These are the top names that you as an advisory group would be using. We have obviously, for their sake, removed their names. But what's quite interesting is that North Star's ability to pick stocks sits right up there as what consistently one of the top performing managers in an equity selection portfolio over time. What is also interesting and important to note is in blue, with that equity carve out of the flexible fund has significantly outperformed the world MSCI World Index, which is the index we try to outperform in terms of the equity component of the fund. On the right-hand side, what we show there, which is, I think, very revealing, is the best equity managers in the world tend to outperform the market by 2% a year, the very best. The equity selection capabilities of North Star over a 10-year period demonstrate very clearly that in 2014, we underperformed the market, and again in 2021. But in every other year, we outperformed significantly. And you can also see our hit rates. We monitor that each month, the percentage of stocks in our portfolio that have outperformed the MSCI World Index, which you can see at some points is up to 70% and even higher. So very high hit rates, very good outperformance of the index over time. On the bottom right-hand side, we also show the win-loss ratio. A ratio above 100% indicates that our winners are outperforming our losers by a margin. And there too, we can see enormous win-loss ratios, in certain instances over 200%. Anything above 100, as I indicated, is what you need to achieve as a manager. So then lastly, just in terms of our global equity capabilities, we've also looked at our ability to, in a very, very a volatile market to add value through trading. And again, we monitor this every month, but I'm not going to go through each one of the bars. Just in the last year, the orange line indicates quite clearly that we've added almost over 4.5% of value by understanding what we think stocks are worth and selling the expensive ones and buying the cheap ones within a select group of stocks that we cover very, very carefully. Then in terms of the next leg of success would be asset allocation. So on the left-hand side, we show the sector that we compete against, and the peer group is in orange. And just put it very, very simply, we know exactly what risk level and a standard deviation the sector runs at all times. We are in red against that. And notice how close we are to the sector. We do not think that managers add huge value by being aggressive asset allocators. And that's very clear from some of the work we showed early on in terms of trying to do macro calls. However, we do have at our disposal a very strong structure around when markets are cheap and expensive. So what we can do is we can push that red block to the right and add more risk when markets are cheap. Equally, we can push it to the left and reduce our volatility when markets are expensive. And that's exactly what we do. We also target a very specific standard deviation that optimizes the return for that level of risk we're willing to take. So every single month, we do quants in our business across all our funds, not just our global fund, to try and understand what risk level we should be at in the fund and what kind of return we can achieve with that level of risk. And this work is consistently applied, as I said, across our entire fund base. Now, the beauty of 10 years of work and having a fixed income team, a global team, and a South African equity team is on a monthly basis, we can get returns across all asset classes from those teams. So because we have a global buy list, we know what the intrinsic value discount is. That comes into our expected return for 3 years. Equally, on a South African buy list, we know what South African stocks we think they're trading at a discount or premium. We can pull all that data together, including fixed income data, and in one simple table, be able to then optimize that information and give us an idea of what asset class exposure we should have. So we know what risks we're willing to take. We know what returns we think each asset class can generate. It then gives us an idea of the weightings we should have across asset classes. So on a monthly basis, we optimize our global portfolio in this case and rejig its weightings to reach these specific levels as per the optimizer. Now, just going in from back to that buy list and the importance of the discount to intrinsic value, you can see we've highlighted that blue block, base case intrinsic value discount portfolio 13%. What does that mean? Well, it tells us that if that portfolio realized what we think it's worth overnight, it had 13% upside. You can see below that Visa's got much higher upside, and Estee Lauder, which we've owned for a while and been net sellers of in the last few months, has downside according to our intrinsic value. Now that 13% for the whole portfolio is a crucial number because it plays a part in this graph. So what we've got here is a long series of data where we track the intrinsic value discount of our buy list in blue. And what you can see is on the right-hand side, that the y-axis, when that discount opens up to call it 35%, the red is our target equity allocation for that level of discount. So what the optimizer is effectively doing is telling us what weighting we should have in equity when the discount is as high as that. In other words, buy the market. Equally, when that discount's dropping, which is happening currently, it's telling us to sell the market. So here's the first point we raise. We have been net sellers of the market in the last few months, having been very aggressive buyers of the market through last year, and in some instances buying, for example, those Chinese stocks that I know a lot of people don't like, but there's a certain amount of risk you're willing to take for the returns you're going to get. So we didn't have huge amounts of Chinese exposure, but we certainly bought some of those stocks in the midst of the decimation we saw last year. Equally tech, when tech fell out of bed, it's hard to do it, but we were buying it. And we were selling the very things you would want to hang on to, like our staples, when they had reached very expensive levels through the crisis. So we clearly are informed quite mechanically when to buy and when to sell. or when to sell and when to buy. All right, now in terms of our asset allocation track record, on the left-hand side, we show our flexible fund, US-based flexible fund based in Ireland. We're trying to outperform that common 60-40 portfolio. We've done that with 3.3% annualized outperformance over time, and we feel very comfortable with that kind of return. On the right-hand side, we show our outperformance against the global flexible peer group, which is 4.4% annualized. Now, just getting on to quants. Then what is quants really in our world? Well, quants is effectively running our screening tools and not taking it to the next level where we allow humans to do deep dives and fundamental work. So we say there are two legs to the equity strategy we're running. The one is our fundamental team decides on stocks based on screening, shallow dives and deep dives, and we decide if a stock's going onto our buy list or not, and we either buy it or sell it. The quant side just doesn't include the human aspect. We stop earlier in that process. And on that basis, we know that there are going to be times when our quants portfolio does better than our human portfolio, and other times when our human portfolio outperforms the quants portfolio. So we've done the back testing work on the quants portfolio. The blue line clearly shows it well outperforms the MSCI over time, and the 60-40 blend, as in this case the S&P as well. And on the right-hand side, we actually show the quants portfolio in practice implemented in our portfolios last year. It outperformed the market by just over 9%. I must state that we outperformed the market fundamentally by 4.5% last year, which is a significant outperformance considering best managers do 2% a year. This year, the fundamental portfolio is doing better than the quants portfolio. So we're doing exactly what we thought. It's doing exactly what we thought it would do. There are good times for the quants portfolio, and other times the fundamental portfolio does well. We have a very long-term track record. It's really getting to the last few slides of doing this. From a Reg 28 perspective, which has had global in it, we go back to managing a fund from May 1999. So we know what we're doing in the space. We understand asset allocation, and particularly the global component, the importance of it in any fund that's an asset allocation based fund. Equally, our global fund has been nominated for a few awards, Citywire awards as well, and it's outperformed its peer group as we expected to, with the kind of structure we just spoke about. And then lastly, the City on the income side, we showed earlier on, income fund has done extremely well. Mark Seymour runs that fund, and Sebastian, his co-manager, have done an exceptional job on that product for many years. Lastly, just a point to note, we have a sizable team now, and just this year we've decided to collaborate on research with First Avenue and include their analysts into our research process. So we've got an even larger team, and so we're covering more and more bases. Our process, we've agreed that our process will be followed, has a very long-term track record, and but those analysts, which we think are exceptional, will plug into our process and assist us to cover more global stocks, more local stocks, and we're very encouraged by having this kind of size team, considering our track record to date, and the more impact we can have, the better going forward. Thanks for your time. I hope I've given you some idea of the effort that we've put into this over a 10-year period, and really the views we have on the market.
Adrian, indeed, and we are much appreciative of that. Unfortunately, I've got a clock chasing me, so we don't have time for questions. But from a presentation, there is clear evidence in your stock picking capabilities. And I do like the whole idea of that you have strong fixed income capabilities as well, because if you're looking for a well-rounded portfolio and sensible portfolio, you do need all of that, and it comes very nicely together in your funds. I'm really looking forward, I'm sure some of the audience as well, in seeing a lot more of your funds going forward. Again, thank you very much for joining us today. We are deeply appreciative of that. Right, next we've got Contrarians Asset Management. Contrarian Value, although not obsessed with the value label and not being contrarian for the sake of being contrarian, but rather sensible in finding companies with solid earnings that you don't overpay for. Maybe just a short note for those of you who don't or may not know Contrarius was founded by the former Allan Gray Chief Investment Officer, Stephen Mildenhall, in 2008. And they've had some great successes ever since. In December or end of last year, BCI have launched 2 feeder funds, the BCI Contrarius Global Equity Feeder Fund and the BCI Contrarius Global Balanced Feeder Fund, which gives you access to the global funds, respectively the Global Balance and Global Equity. This is the only 2 funds that they manage, so little room for distractions, and it actually shows over time. It is my great privilege to welcome Heaton van der Linde, all the way from the UK. Heaton, thank you so much for joining us today. We're really looking forward to your presentation and what you offer to clients and how you see the world.
Thanks very much, Eugene. I'm actually in Cape Town at the moment and based in South Africa, but visiting Cape Town. And so, yeah, let's just dive in, given the clock is against us. I'm going to be talking about valuation disparity, where we're finding value currently in markets. One can move down the slides a few. Yeah. I think a number of the speakers have already talked to some of the things that we think are important. We think that the reopening of China's and abandoning their zero COVID policy is very, very important. Clearly, inflation, which had been negligible for a decade or more, has now reared its head, and that's led to interest rates that are higher. We think the fact that interest rates are higher and more normal is quite positive, in that the Fed, for the first time, has the ability to do something if they have a problem. Previously, when there were issues that arose, they didn't have much scope. They have plenty of scope now. Of course, inflation, well, fixed interest is now more attractive than it's been in a long time, given the high interest rates. And so one's looking at relative value within that. Equities should be able to protect you against inflation if companies have pricing power. And so naturally, one is considering that in your decisions. The investment philosophy we follow, as depicted by the graph, I'm sure you've seen many of these types of graphs. I won't dwell on it for long. Our analysts spend their time looking at that slightly fuzzy line that's upwardly sloping in a straight line. Average company growing at the rate of growth of the economy. A sector may grow faster than the economy for a period of time, but ultimately it's constrained by the economy it grows in and the efficiencies companies can achieve. So better quality companies will achieve a slightly higher rate of return than their industry. What we do know is that the share price fluctuates quite wildly around what we call that fair value or intrinsic value. And there's times when market participants place a high price on a company, and it's typically when things have gone particularly well, and the company people trend line that into the future, that the current rate of growth, current revenue growth is going to continue indefinitely, perhaps the current high operating margin. Tough times come on the company, and perhaps a few years later, share prices are down 60, 70, 80, 90%. And maybe the classic example of that would have been what happened in the pandemic, where shares were bid up to extreme levels and then, of course, came plunging down. We like to buy when we can find the share price trading below its intrinsic value. And we believe that over time, if the company executes and it can achieve its long-term rate of return, that the price will in fact reflect its fair value. And then we sell that little sell bar. Importantly, we don't hold on. We don't try and sell a company at a price above what we think it's worth. We're wanting to sell so that we can reinvest those proceeds in another company that we can find trading at a margin of safety discount. We've got that dotted line in there, just showing what we call an extreme event, when shares that are cheap become even cheaper. It's fairly typical for us to buy early and sell early. But when they become shares that are cheap, become very cheap, and then can even become extremely cheap. We saw that in the pandemic, where certain shares that were really cheap going into the pandemic became extremely cheap. They were the companies that were hard hit by the initial shutdown. And yet shares that had become expensive and were trading at pretty lofty expectations of earnings growth and returns on capital went to extreme highs. And so you often get that, the different sectors of the economy stretching. And we saw that in 2020 and some of the unwinding in 21 and 22. So we can move on to the next slide. It's been our fund launched 31 December 2008. And so for global equities, it's been a good period. The MSCI World Index has grown from $10,000 up to as high as about $45,000 had you invested at the start, to around $40,000 today. This was drawn up on the 20th of February. So a good period for markets. You can see this, the drawdown of the pandemic. You can see the flash crash, if you remember that. You can see the European debt crisis earlier in the decade. Yet 10,000 has become 40. If we move to the next slide, you'll see how has the value index done, the MSCI World Value Index. It's been a pretty torrid time for value managers. The 10,000 has grown to just a little bit over 30,000. And the drawdown in the pandemic was pretty large as well. If we move to the next slide, the flip side, of course, is that growth has done particularly well. And so you can see the gap between the sort of orange line and the green line was at its maximum in late 2020 and the end of 2021. And you can see how that that gap has now narrowed substantially, as for the first time in the last year and a half, you've seen a growth underperforming value after the substantial period of outperformance. If we look at the next line, it overlays the average manager's return. This is drawn from Morningstar. And I guess, you know, this graph makes it look like the average manager is a value manager because the return is fairly similar, slightly underperforming the value index. Of course, we know that's not the case. If you look at portfolios, and I think Dion had a slide earlier on in the very first presentation showing that there are very few value funds around anymore after this very tough decade. What this perhaps reflects is fees, as was mentioned. Sorry, if we can just go back one slide. I think it reflects fees to some extent, and it also reflects perhaps that during the initial half of this period, the average manager was probably overweight in energy and underweight in technology. And subsequently, when technology had been doing well for some years, invested in technology. And then, of course, technology suffered as a sector like energy has risen. If you put the next slide up, you'll see that it just overlays our fund performance. And so what you can see is that we're very different. And our name suggests that, contrarious. We're happy to own stocks with value characteristics. We're happy to own stocks with growth characteristics. We don't own, a stock because it's going up, like momentum strategies. We are happy to own quality companies. We're also happy to own slightly lower quality companies if we find them attractive relative to their share price. We were very pleased that, notwithstanding the big drawdown of the pandemic, the shares that we owned were perfectly not positioned for a pandemic. We took the tough decision to sell out of our energy holdings because they were capital impaired on their balance sheet, and we were fortunate to be able to redeploy them in other assets or other equities that had fallen dramatically and were being priced as though they'd never come back. So the strong recovery and then the outperformance. So over time, the growth index has taken it to around $50,000, that 10,000, and currently our fund is just above 70,000 of that initial 10,000 invested. If we go to the next slide, we take this just a little bit further. So that graph previously was just a 14-year period. This goes all the way back to the 70s. And it's just simply growth versus value. I'm sure you've seen this depicted in many ways. It's a relative graph. So while the graph is upwardly sloping, growth companies, as defined, are outperforming value companies. This is just using the attribution of the MSCI of growth and value. And you can see that upwardly sloping line from the end of the pandemic, growth companies outperforming all the way through, from the end of the credit crisis, all the way through to the end of 2019, beginning of 2020. And you can see at that point, you had reached the same peak of relative outperformance as you had in the dot-com bubble. Now, the dot-com bubble was probably a bit broader. It was fintech and as well as a large cap bubble. And what we do know is many of those companies took many, many years to get back to their previous share prices. Some of them have never got back there. And we would expect nothing less going forward. You can see when the pandemic hits, you went from those already lofty relative valuations where value companies were generally cheap and growth companies were generally expensive to record levels. We call them the Twin Peaks in October of 2020. Then that slight drawdown, and then the Twin Peak led only by the large caps into December 21. And then the substantial reduction in value of growth stocks. So from 150 on the index level, you've retreated to 120 as value-oriented stocks have outperformed. You can go to the next slide. The next slide just seeks to look at that blown up period. And so this is the run up to the dot-com bubble, 97, 98, and its strong rise. And you had some very, very real companies who would benefit from the internet. You also had some very crazy companies, no revenue companies that were just on the hype, which ultimately went bust. But Microsoft took from its peak in about $60 in 2000, it took all the way to 2017 to get back to that level before it powered to new highs. And you can see just how extended this period of unwind was. And we would have thought that you'll face something similar. You've had an initial sharp drawdown. We think there's more to come. And value is still to be found in value-oriented stocks as opposed to growth-oriented stocks. However, we are seeing some value in growth stocks, and I'll talk to that shortly. We can move to the next slide. So yeah, perhaps just using a real-life example, this is just using Exxon and then Zoom, of course, we're using today. Great product. You can see it bumbling along before the pandemic, Zoom, and of course, rising dramatically. This is its market cap rising from around 25 billion to over 150 billion. And Exxon, on the other hand, having had the big excesses of oil in 2014, 2015, perhaps overinvestment at that time, you had the big unwind, and it was now trading at only $150 billion market cap. Just touch one slide on, please. You can see those numbers relative to their sales and relative to their earnings before interest and tax. You can see that Zoom had no earnings before interest and tax. Its sales were relatively small, but it was being priced as though it was going to have enormous sales into the future. And of course, interest rates were low, which has changed. We know what happened, everyone knows the next slide. If you look at where Exxon went to, its market cap went from that 144 to $454 billion. You can see that sales went up, but not dramatically. It's not like they went up 10 times. And its earnings went up meaningfully from 11 billion to 67 billion. We think Exxon's attractive at its current levels. We don't own it because we have other energy companies more attractive. And I'll talk to that aspect shortly. However, Zoom, on the other hand, actually as a company, it grew its sales dramatically, and it grew its earnings before interest and tax to 2.6 billion. The problem was just the lofty valuation that had been given to it ahead of time. And so you can see how it's now trading at 20 billion, and it's not likely to reach 150 billion of its previous highs anytime soon, we would have thought. We can move to the next slide. Another aspect I'm sure people have seen comment on is just the degree of concentration in the market cap, and that talks to indices. So we're not particularly bearish about markets, but we're certainly not finding the great value in the major components of the indexes. What this graph shows is the percentage that the top 5 shares at any one time have represented of the S&P 500. And you can see that at the dot-com bubble and the large cap bubble that I spoke of, I think Coca-Cola was in there and Microsoft and I think GE was in there. It touched on 18%, or almost 18% of the S&P 500 was represented by the market cap of those 5 companies. You can see the top 5 got to over 24% during this pandemic and pandemic recovery period, now down at 20%. What's interesting is that Berkshire Hathaway has come in there. Just a couple of quarters ago, it would have been Tesla and Meta, Facebook previously. So the composition changes. We would not be surprised to see this come down to more normal levels where the index is not dominated by, as dominated by these mega caps. Move on a slide. You'll be pleased to know, Eugene, I'm hoping to catch up some time for you. We're coming quite close to the end. This graph tries to draw this together and says the top 10 shares in our portfolio on the left-hand side, and compares that to the MSCI World Value Index top 10 shares and the MSCI World Growth Index top 10 shares. So what I can say is we don't own, to any large extent at all, any of those shares in the growth index. We've previously, Apple was our top share for many years, over 2012, 13, 14, that period, 15. We were in fact overweight technology shares all the way to 2017, as they were trading on relatively low multiples, particularly if you excluded the cash from their balance sheets, on free cash flow multiples. relative to their earnings prospect. And the earnings prospects have come through, the services, the value of their services business has come through as anticipated. But of course, the multiples have gone up dramatically. And we simply find these very high quality companies not as attractive. Microsoft equally was in our top 10 years ago, Nvidia as well. And we have held Meta from time to time. So we think that value is more attractive than growth at this point. Within value, however, we think there's great disparity of valuation as well. And so those top 10 shares, neither of them are in our portfolio. You'll see ExxonMobil and Chevron. There were no energy shares in the top 10 as little as a year ago. Exxon and Mobil and Chevron, we own other energy shares like Transocean, Valaris, Noble Corporation, Diamond Offshore. Our initial energy holding when we went back into energy, because the thesis for energy exists. I think one of the previous speakers commented on the tremendous underinvestment in energy over a period of time. And so notwithstanding the oil price, these drillers are very occupied at the moment. Their drill rigs are fully put to use, and they're able to take a few out of being cold stacked, and you're seeing day rates for their business go up. Like a hotel occupancies, well, the usage of their rigs is up, and the rates at which they can charge is going up dramatically. So rather than Exxon and Chevron, we own other energy companies, typically value type businesses, trading at fractions of their replacement cost of their rigs. I mentioned growth. We do think there are some attractive opportunities in growth, and growth, as we know, firstly in 2021, that second, third, and fourth tier, sometimes referred to as the junk growth, fell dramatically, and shares were down 80–90%. It was only in 2022 that mega cap tech fell and joined, or not as far, but fell meaningfully. Now, we think that there were some gems thrown out, and so don't throw out the baby with the bathwater. We think there's some great growth companies, which long-term growth businesses should ultimately be high operating margin businesses and return on capital businesses. But of course, the market that was previously rewarding these companies for growth at any cost, acquisition of users, despite cash flow losses, of course, is not rewarding that anymore. But the competitive environment for these companies has in fact improved dramatically. They are not facing venture capitalists throwing $1 billion or $2 billion at another competitor to start up, because money now costs something. So the competitive environment is better. They're acting more rationally. You're seeing, if you're third or fourth operator in a region, these companies like DoorDash, like Grab Holdings, Just Eat Takeaway, Uber's lower down in the portfolio, you'll see that they exit those markets. They're interested in becoming cash flow positive. They're companies that in transition. We like those sorts of companies where the market is not seeing the cash flows that are coming. They're penalizing them for the past, really, and the past growth strategy. And the other aspect, and you see in our portfolio, is Paramount Global, Warner Brothers Discovery. Great content owners. These businesses own tremendous content. They're busy undergoing a transition again from perhaps linear TV or cable TV through to streaming. Previously, the company loved the acquisition of users through streaming. Now they don't. The market. We like those sorts of situations. They own very, very valuable content, and we think they ultimately are successful in their streaming abilities. At the same time, the down market in advertising is perhaps hurting them. So to perhaps conclude around here, we think there's 3 areas of value. That next slide perhaps is useful. It just shows the value between, in the blue, it's the World Energy Index, so companies making up the World Energy Index, divided by the MSCI World Index. So when the blue line was downwardly sloping, energy was horribly underperforming from that previous peak in pre the credit crisis, and then 2014-15. And then the energy prices overlaid on that in red, the World Trade WTI West Texas Intermediate. We think there's tremendous value still to be had in energy. As I say, we have moved from owning oil and gas producers to more the oil services businesses like the drillers, who, if the oil price falls a little bit, if the oil price goes up a little bit, they're going to make money. It's not directly geared to the oil price. So perhaps the last slide is you can see those three overweight areas: energy at 35 versus the world index at 5, consumer discretionary, which is much more these mobility companies and food delivery companies, as well as, I didn't mention, online gambling and sports betting companies we own. If you look back a year or 2 years ago, coming out of the pandemic, we owned a lot of retailers sitting in there. We don't own many of those anymore. Those repriced to fair value or towards fair value, and other opportunities emerged. And then you see that last opportunity, communication services, 25 versus 7. Perhaps the third, so between value and growth, and then some growth shares. And then I didn't really talk to value particularly, other than to say that we didn't own those top 10 shares in the value index, which, apart from Exxon and Chevron, include healthcare and financials. And we essentially, you can see in this graph, we are, when it comes to technology, we're underweight. When it comes to healthcare, we own 0, and financials, we currently own 0. So by not owning those sectors, we're finding them less attractive. And it's not to say we think banks are ridiculously expensive. We don't, just we're finding much better value elsewhere. So yeah, we think there's great opportunities in the stock market at the moment. We think it is a stock pickers market. We aren't drawn to the big indices, but we think there's, and not perhaps as bearish as some might think. Eugene?
Peter, thank you so very much for that. Very insightful indeed, and truly a really great firm that you are part of and representing. Fantastic work that you're doing for you and your clients. Very interesting how a lot of managers spoke about value today, but very different, that disparity between, you know, some of the value companies and the holdings that you've got in your portfolio. For our audience, if you have any questions, I'm not going to take questions now. Like I said, you know, we are being chased by a clock, unfortunately. But if you want to get hold of Heaton, please let us know. More than happy to engage with you at any kind of forum. Or if you have any questions, please directly to our team or to Heaton directly, and we'll get the answers for you. Heaton, thank you so much.
Great pleasure, Eugene. Thank you. Thanks to the listeners.
On the feeder side, and show some business your way as well. For our last session for this afternoon, and I'm sure for those Raging Bull Award party goers, it's becoming a very, very long day, but not to say the least, we've got T. Rowe Price up for our last manager of the day. A true global investment management firm with close to 950 investment professionals. Olga, I just want to check quickly. I've got some noise in the back. If you can maybe see where that's coming from. No? Right. We welcome, and we're glad to welcome Andrew Clifton all the way from London. Andrew, good afternoon. Thank you so much for joining us today. We really appreciate it of your time. You're a portfolio manager and part of the equity division, and also looking after the T. Rowe Price Global Value Equity Fund, and subsequently BCI has the BCI T. Rowe Price Global Value Equity Feeder Fund. Andrew, thank you so much. Your slides are up, and you are welcome to start if you are ready, sir.
Thank you, Eugene. Very good afternoon to you. I actually can't see my slides in front of me. Oh, there we go. Perfect. So I'm aware it's been a long morning for your clients and colleagues, so I'll keep this short, but really just give you a quick highlight of the Global Value Equity Fund. And as Eugene said, T. Rowe Price is one of the leading active global asset managers. We're US listed, but globally established. We have 1.3 trillion of assets under management, and we're focused upon fundamental research in terms of generating insights to generate returns for our clients. Very pleasingly, we have recently been awarded Citywire's Best Fund Group in South Africa in the field of global equity. If we just look on the next page, T. Rowe Price is diversified across active asset classes, and within equities, we are diversified across the style spectrum. And our value franchise is a very key part of that. We have very well established growth strategies and core strategies, but value is absolutely integral to our firm as well. And on this page, you can see how our AUM has developed in our value strategies over the last 20 years or so. And along the bottom, the product evolution that we have overseen. And really since the 1980s, we have been looking to make value a more appreciable part of our business. We have continued to invest in our capabilities and products. Clearly at times in the last decade, many competitors found the going too tough. And I think you referenced that there were now few value managers left. We wouldn't go that far. There's still a healthy competition, but we believe we are marked out by a continued commitment to growing our value franchise. So currently, across all of our value strategies, just over $180 billion under management. And in terms of products, you can see along the bottom, our global value equity strategy that I'll talk about in more detail, we launched in 2012. And we are now seeing good momentum. Just on the next page, I just want to reiterate the importance of fundamental research to our firm and to the Global Value Equity Fund. It is the absolute foundation of all that we do. It is a style agnostic, collaborative platform with very significant experience. Many of our analysts have been following their companies in industries for many years, in some cases, several decades. And for the Global Value Equity Fund specifically, we have access to close to 100 analysts who can give us insights into how companies are evolving, how technology, how markets, how competitive environments are changing. And clearly, even as value managers, although we may not be investing in the latest technology trends, we clearly need to be aware of what is going on in an ever-changing, fast-paced world. For the Global Value Equity Fund specifically on this next page, you can see on the right-hand side the parameters that we manage the strategy to. In essence, we are trying to find the most attractive 80 to 100 value opportunities that we can find around the world. And really the market anomaly that we're looking to exploit is that many investors do not like controversy and uncertainty. And I'm sure it's been referenced several times, but essentially, when there is that market uncertainty, prices become decoupled from what we perceive to be the intrinsic value of a company. And we need to understand whether this controversy is real, because very often the dislocation in the share price, the short-term impact on the company's valuation is normally far too much of an overreaction compared to the true change in the underlying intrinsic value of that company. So what we do is we work with our analysts. We use fundamental forward-looking insights to understand whether the problem can be resolved. If it can be, we can certainly then undertake further work. But if we do believe the problem is likely to be ongoing and may not be resolved, we're highly likely to move on. Value investing is littered with many investors who've tried to call the bottom in structurally challenged businesses. And we find that those value traps are best avoided really almost at any price. When we have the confidence the problem can be resolved, we need to understand the degree of mispricing that has occurred. And we run a range of different scenarios, ranging firstly from a recession bear case scenario to ascertain the degree of downside, right through to a bull case, a blue sky case. And we are trying to find the most asymmetric opportunities that we can find globally. We can still be interested in a business that may have 50% downside in a bear case if correspondingly the upside is of the order of 100, 200%, or indeed more. Critically, and I think this is our strongest competitive advantage against those value peers that we come up against, is that we look to implement this approach across the value spectrum. Different types of value are effective at different times, and opportunities are broad. So we don't just look at quality value or defensive value or deep value. We have a consistent exposure to these different types of value because the market is always evolving and we don't want to be dependent upon one particular type of environment. So on this next page, you can just see how we present, one more page, please. You can see how we present the value spectrum, and defensive value, which will typically be around half of the portfolio. These are good quality companies in the main. They can have good products, good cash flow opportunities, decent management teams, but they can still face controversies. And we find these types of companies in sectors like consumer staples, utilities, and healthcare. A healthcare company, for example, can be under a cloud because the market may doubt the ability of one of its blockbuster drugs to continue to grow. Alternatively, investors may doubt the ability of its pipeline to come through and develop to offset other expiring patents. So we work with our analysts to understand the degree of risk in the name, whether this problem can be resolved, and then the asymmetry of opportunity. Always trying to work out the degree of downside first, but then accordingly also how much could we be rewarded. But what we also do within the portfolio is trade quality for upside. And we go over to the other end of the value spectrum, embracing more cyclical risk, financial risk, management risk, perhaps sometimes ESG risk, and invest in more cyclical and deep value companies. And these companies will make up the corresponding 50% or so of the portfolio. These companies are lower quality, but they can present fantastic opportunities. What is important to do is to make sure that we control for risk adequately. And one of the main ways that we do this, beside the quality of our research, is by position sizing appropriately. So they will never be the largest positions in the portfolio, but collectively, the deep value and cyclical element of the portfolio will still be making up around half of the capital that we deploy. Now, the exact allocation between the different types of value will evolve according to where we find the best opportunities, but essentially we will look for a permanent allocation to these different types of value just to make sure that we can continue to develop a less volatile pattern of performance, which is what we have displayed historically. On this next page, just a quick snapshot of the portfolio as it stood at the end of last year. If we can move on the page, please. So just under 100 issuers, a truly active approach, 85% plus active share. And I just highlight by the different groupings the main investments that we have. So within developed markets, in our defensive companies, healthcare companies, utilities are typically featuring quite strongly. But also we have found increasing opportunities in more cyclical companies, particularly within energy within the last 12 months, given the changes that we have seen in that marketplace. And there you can see the leading cyclical exposures that we have. But then also we have companies that we regard as having more deep value characteristics, where there is an element of risk, where we are position sizing appropriately, and also emerging markets, which can be up to 10% of the portfolio. You can see there the leading investments that we have in that grouping, currently led by Indian, Chinese companies, with also exposure to Vietnam and Brazil in that grouping. Just on the next page, the sector composition of our fund is shown on the left, but also the evolution through time. And the classic value sectors of utilities, financials, and energy are well represented within our value fund. As we'll see in a moment, we do have persistent value characteristics, and utilities and financials in particular, we have found to be a good ongoing source of value opportunities. Energy, we have at times been underweight when we have had concerns about the structural setup in that marketplace. But clearly, given the changes in the market and that industry in the last 12 months, we have moved to a more appreciable overweight position. The largest overweight exposure that we have currently is healthcare. This was a sector where we were underweight at the end of 2020 when it was out of favor. We found many attractive opportunities as investors at that time were looking for more exciting cyclical stories. There were also concerns about US drug pricing. And really through the course of 2021 and 2022, we added consistently to that sector. Now it has become more of a consensus home for capital as investor worries about the cycle have increased. And we are accordingly starting to decrease our allocation to that sector, but it still remains an overweight position for us. In terms of the classic growth sectors of consumer discretionary and technology, you can see that they are our biggest underweights, but we can still find good opportunities in those sectors, not least within consumer discretionary, within the automotive space, where we've been doing a lot of work on trying to find those winners in the new world over the next 5 to 10 years. And that does include many of the traditional automotive manufacturers. And also within technology, although certain parts of that sector, particularly software and services, are really off limits in the main, other parts of the sector, especially what we term cyclical tech, and especially semiconductors and semiconductor equipment, that is actually an area where we have been adding to, both towards the end of last year, but also in the current year to date. From a regional perspective, you can see that a persistent feature on the next page is our underweight to North America, principally the United States. But with that country still being close to 70% of the benchmark, we obviously have still a decent representation of investments there. And indeed, in certain sectors, such as financials and utilities, we are overweight US names. But in other sectors, we often find better opportunities in other parts of the world, in large part reflecting the re-rating of the US market through the course of the last decade. And also, given that we have scope to invest in emerging markets up to 10% of the portfolio, that has largely been financed out of our US allocation. On the next page here, you can see the characteristics of the Global Value Equity Fund. If we look at the price to book at 2.2 times, you'll see it's an appreciable discount to the MSCI World Index and is broadly in line with the level of the MSCI World Value. I think that is currently showing about 2.1. We have a lower price to earnings ratio, broadly in line with the MSCI World Value benchmark at about 14 times, and also a lower return on equity company, because clearly there are some companies in our portfolio that do not meet maybe the quality characteristics of the benchmark in aggregate. And just very quickly on performance, on this next page, we can see a summary of how we have performed against the MSCI World Benchmark, our core, our primary benchmark. In terms of assessment of our manager, of our management of the fund, and in terms of how we assess we're doing as a value offering, we also place a high degree of importance on our performance against MSCI World Value. And we have been consistently outperforming that benchmark over the longer term time periods. Clearly against the core benchmark of MSCI World, it has been a challenging environment for much of the last decade. But the approach that we have, and in particular, investing in more defensive companies at certain times, has enabled us to stay reasonably close to the MSCI World Benchmark since inception. And whenever we have had a value recovery in the marketplace, we have also offered very good participation. And indeed, you can see that our one-year number is appreciably ahead of the core benchmark and is broadly in line with the World Value benchmark. Just in closing, I'm aware time is pressing on. Just a few points on the general market environment. On the next page here, you can see the sharp regime change that value suffered for much of the period post the great financial crisis, and then the recovery more recently. The question clearly for investors is whether this is going to be sustained or is it really just a short-term blip. Two things to highlight that I would emphasize. Firstly, on this next page, we would argue that valuations are still attractive as a starting point for making an allocation to value. This is showing the valuation of growth companies versus value companies. It is only for the US market, but it is true globally. And it's showing the pattern really for the last 45 years or so. We have come in from the extremes where growth was at a very high premium relative to value, but we are still trading at around the 80th percentile versus history. And we feel that by no means have investors missed out on the potential recovery in value. And on this next page, just in closing, there are various scenarios that investors are presented with. Perhaps a return to the years of the last decade, shown on the left-hand side, which would be the value manager's worst nightmare. Alternatively, perhaps a far sunnier world, as shown on the right, where inflation and interest rates do normalize, where fiscal policy is more expansionary, where monetary policy is really secondary to ensuring that fiscal policy can be effective, And generally, this last column on the right is very much the perspective that we have of the world that we're moving into over the next decade. And in particular, on the next page, there are really three agendas that we feel are causing dramatic change for investors and for the world at large. Firstly, the green transition is necessitating dramatic investment in green technology as we look to decarbonize the world and industries. The social agenda has clearly dramatically changed. The pandemic taught many people that it's better to have money sent to them directly than it is to be given to Wall Street, if you like. And as we're seeing now, support for energy prices is something that would not really have been seen 5 or 10 years ago. And thirdly, the resilience agenda, the desire for more secure supply chains, the desire for reshoring. This too is going to lead to higher expenditure by companies, by industries, and also by governments. So in closing, just on this final page, the T. Rowe Price Global Value Equity Fund, we feel, is operating now in an environment that is far more conducive to investing with a value philosophy. We look to capture the most attractive 80 to 100 value ideas from around the world. We do this across the value spectrum so that we can exploit the breadth of opportunity that we face, and also to ensure that we can perform in a wide range of different environments.
Andrew, thank you so much for that. Did you want to go through any of the performance slides?
Well, yes, I mean,
No,
I was
just the
rather mindful of the
disclosures.
time that had been taken up. I mean, these slides are in the appendix, but maybe people can look at subsequently. But yes, I mean, just on that page that was just up, page 21, I think what is heartening, and this really speaks to the next page, please. This speaks to the strength of our platform, is that we are not just dependent upon one or two views in this 80 to 100 portfolio. Against the core benchmark, we have clearly struggled with a growth environment at times, and also allocation effects with certain sectors, particularly technology, being very much in favor when we have been consistently underweight. But I think what we can demonstrate is a good breadth of attribution. And indeed, when you look at this analysis, particularly against MSCI World Value, we see positive or neutral contributions in really almost all sectors, apart from the two consumer sectors. But also when you look at it from a regional basis, from a market capitalization basis, and also the different types of value, we see a broad contribution over the decade or so since inception in 2012. So again, it speaks to the strength of our platform, the breadth of our insights, but also hopefully gives confidence in its repeatability and also dependability.
Andrew, thank you so much for that. We are very much out of time, but I do have one question for you. Yes. And we hear more and more talk about China's revival. We know that the US are taking liquidity out of the market, and financial conditions are definitely tightening. What is your view on China's recovery, and can that perhaps offset some of that liquidity being sucked out of the US?
Well, certainly the message we're getting from our colleagues on the ground in China as they now go out and meet a lot more industries and companies is that the reopening is very vibrant. We're seeing a sharp pickup in activity, and this is against the backdrop that undoubtedly there are some very significant value opportunities in the China market. Obviously, there are bigger geopolitical uncertainties, and it's key that we control for risk. But within our scope to invest in emerging markets, we are invested in China. We have 4 stocks, one of which is trading appreciably below cash, we believe, and others represent very strong value opportunities. So we are controlling our total position size to China. In aggregate, it's about 3% of the portfolio. But within that, we have found 4 very exciting companies. And undoubtedly, the bounce we have seen in China has been quite pronounced, but I don't think one should underestimate the degree to which it was out of favor 7 or 8 months ago.
Exactly that. Andrew, thank you so much again from our side for joining us today. We really appreciate it of your time. To you and all our other presenters of today, thank you for the excellent work done. The investment professionals and your firms clearly stand out, and it shines through the top quality presentations that you've done for the day. We've also seen today that forecasting doesn't work, but rather that finding fund managers that can find companies with solid earnings growth through any cycle is key. No one fund manager can cover the entire globe and all stocks, and hence the reason for different views and different investment philosophies. Today, our presenters presented on several ways of how to value such opportunities and very compelling arguments on how they get there in their own different way. What makes success of a good manager, I think, is their skill, experience, and well-founded investment process and evidence that it works, of which we've seen a lot of today. There's some outstanding questions from our audience. We'll try to get commentary on that to you as soon as possible. But from our side, from the BCI side and the BCI team, many thanks for our audience for joining us today. We know we went a little bit over time, and we do apologize for that. But we remain grateful for your continued support. And thank you for your support. And because of your continued support and the great work being done by our fund managers, BCI is now the 5th largest manco in South Africa. So again, thank you for that. Special thanks to all the BCI team for making all these sessions possible. And keep an eye out for invites that might be coming through to you for the rest of our boutiques on Wednesday sessions. It's been an absolutely long day, and it's been a thrill to have you all on board. Again, to the audience, all our magnificent presenters, thank you so much, and we'll see you shortly again.